Hello and welcome to Session 14 of the Basic Tax course. Session 14 is the first session of Part 2 of the Basic Tax course, and as such we actually have no quiz or homework review, so today we begin with the lecture. And we're going to start off in the student manual by flipping to the top of page 2. And this is one of the areas of tax code that I like to make a joke out of because the tax code does it quite often. The tax code says that all assets are capital assets unless they are one of the following. And so I like to say, well, all assets are capital assets except when they're not. So let's learn when they're not. And this particular list of what's not an asset and what's not a capital asset comes from Pub 17, page 103. It includes stock or inventory held for sale to customers, accounts or notes receivable acquired in the ordinary course of a trade or business, depreciable property used in a trade or business, real property used in a trade or business, and copyrights, literary, artistic, or similar property created by personal efforts or acquired from the creator under circumstances that entitle you to the creator's basis in the property, and U.S. government publications that are free, like Pub 17. So you can order those from the IRS free of charge, so it is not a capital asset. Pub 17, that is. Next in line, all of the following assets are capital assets. So we just read what's not a capital asset, but IRS says all of the things I'm about to read you next are capital assets. Personal use property, dwellings, cars, furniture, jewelry, collections, etc. Investment use property, including land, stock, municipal and corporate bonds, collectibles, antiques, etc. And business use property, but only certain intangible personal type property such as goodwill or franchise, plus any net Section 1231 like-kind exchange gain from the sale of business use assets. So the first question you might be saying is, okay, I've just explained to you that what is a capital asset and what's not a capital asset. What do I care? Well, the reason we care about it is because if it is a capital asset, it's eligible for capital gain treatment if we hold it long-term and then sell it. And typically, when we sell a long-term capital asset, it's going to get reported on Form 8849 and Schedule D. And if it's not a capital asset when we sell it, it doesn't belong on those forms typically. Now, it might end up on them via another form, such as Form 4797, which is used to sell business property, and you might get that Section 1231 gain flowing through to the Schedule D again. But in general, understanding when we have a capital asset and when we don't, the importance of that is when we sell it, what do we do with it, and does it get that special capital gain treatment? So today's class is called Basis of Assets, and basis is essentially cost. Your cost basis in property is usually your purchase price. However, any of the following situations can give you a different basis. You received your property as a gift, you inherited your property, you received property in exchange for services rendered, or you paid transfer taxes and insurances or other closing costs upon the acquisition of your property that you could not or chose not to expense. So let's take a look at some of these items where what you paid for it is not your cost because you didn't pay for it. Or maybe you did pay for it, but there's an adjustment of some kind. And the first of these in line is property received as a gift. If you receive property as a gift, you must know its adjusted basis to the donor just before it was given to you, its fair market value at the time it was given to you, and any gift tax paid on it. Then apply one of the following two rules to calculate your gain or loss when you sell or dispose of the gift. And here we have the two rules. The first one has to do with the fair market value at the time of the gift is less than the donor's adjusted basis. In other words, the donor bought something and it dropped in value by the time they gave it to you. So their cost is higher than its value when they give it to you. What happens then? Well, to figure a gain, your basis is the same as the donor's basis. And to figure a loss, your basis is the fair market value of the gift when you received it. The second option is that the fair market value of the time of the gift is equal to or greater than the donor's adjusted basis. So the donor acquired something, has a cost in it, and at the time they give it to you, it's risen in value. That would easily happen. Well, in most real estate markets, houses tend to go up. So For the history I've been teaching tax school, real estate's been a good example. It tends to go up over time, but of course we've been in a slump the last few years. But that's a good example. You've acquired a house, maybe you're a mom, and you've had this house for several years and you decide to give it to your kid, and you paid $60,000 for that house and now it's worth $200,000. That would be an example of a gift that the value is higher at the time of the gift than when you bought it. So what do we use for basis? Well, to figure a gain or a loss, your basis will be the same as the donor's adjusted basis. So the rule is that if the value has gone up or stayed the same, the donor's basis and the recipient's basis are the same. But if the value of the property has declined, then you're going to go with the lower value or the basis, depending on whether you sell it at a gain or a loss. Your basis in a gift may increase or decrease because of certain adjustment items which take place after you receive the gift. These adjustment items can include allowable depreciation, casualty or theft losses, and capital improvements you make to the property after you acquire it. What you should note is that the bottom line behind these rules is that the IRS is working to minimize the loss and maximize the gain for IRS purposes. If the value of the property has gone up, there's really going to be no different treatment between the donor and the recipient. But if the value has gone down, the IRS is not going to allow the recipient to realize the full loss based on basis. They're only going to be able to realize the loss, which is the difference between the fair market value on the date they got the gift and what they get for it when they sell it. Jackie received a gift with a fair market value of $100 and a basis to the donor of $150. Jackie sells the gift for $180. What is her profit from the sale? So let's look at what's the rule. Fair market value is 100. The basis is 150. We sell it for 180. What is going to be the basis? We're going to get to go with the basis of 150. If we sell it for 180, we're going to have a profit of 30. Okay. A number 30 is the correct one, and here's why. We're not going to be forced to pay more gain, but we're not going to be allowed to claim a full loss when it goes down in value. So in this case, we sell it at a profit, so we're going to go with the donor's original basis. And we sell it for 180, that means the profit is 30. Let's move on to number 2. Henry received a gift with a fair market value of $150 and a basis to the donor of $100. He sells the gift for 80. What is his loss from the sale? The answer is 20, yes. So he's not going to get to claim a higher cost by going with fair market value. Okay, so the value went up. That's fine. Then he gets the gift and the value drops. He's going to be allowed that $20 loss. Next one, Sally received a gift with a fair market value of $120 and a basis to the donor of $80. She sells the gift for $100. What is her profit or loss from the sale? C is the correct answer. Go on to number 4. George received a gift with a fair market value of $120 and a basis to the donor of $100. So the value has gone up. What happens when the value goes up? The basis for the donor and the recipient are equal. So he sells the gift for $150. What is his gain? His gain will be $50. So the fair market value is more than the cost, and you don't get to step up your cost as a recipient of a gift. So you're going to stick with the basis of the donor. 100 from 150 is a gain of 50. Jack received a gift with a fair market value of $100 and a basis to the donor of $150. He sells the gift for $50. What is his loss from the sale? Fair market value of $100, cost to the donor of $150, so the fair market value is less than the cost. What is going to be the cost of the recipient? It's going to be the lesser of those two numbers. So we're going to go with a cost basis to the recipient of $100. He sells for $50. That means B is the correct answer. And these answers, if you want to look them up and again after you've already forgotten today's class in a week from now, are on page 35 of the manual. Yes. There's a question in the classroom about holding period, and the rule with holding period is that when you receive a gift, your holding period is the same as the donor's. So you would go with the donor. Next topic in line is property you inherited. Now, inherited property, I consider that to be a dream. All you need to know is when the person died. For the most part, what was the date of death, and the riddle is solved. So let's see why. Basis calculations for inherited property are usually simple to calculate, as I just said, and this is because the basis in most inherited property is the fair market value of that property on the date of death of the decedent. However, the following information should be observed, and you should be aware of it as tax professionals, because it can come into play, even though it is rare. Firstly, if we have a decedent who died before 2010, and that would be most of the people who ever died in the world, right? They died before 2010. If you acquired the property through inheritance from a decedent who died before 2010, your cost basis is the fair market value of the property on either the date of death of the decedent or 6 months after the date of death of the decedent. The decedent's estate establishes which valuation date shall be used, and once the estate chooses a valuation date, that same date is used for all assets of the estate. The date that the property actually transfers to the beneficiaries or heirs has absolutely no bearing on the basis of issue. On the issue of basis, rather. Now, I've got a note here that this is a decedent who died before 2010. It should actually be also any decedent who died after 2010. Just realized I hadn't updated it to include that. So decedent died before 2010 or after 2010, but not during 2010. And so most people die with an estate so small that there is no estate tax due, there is no estate tax return filed. So the administrators or the executives of the estate aren't even consulting with tax experts or attorneys to make a determination to use a date of death that is, or a valuation date that is 6 months after the date of death. Most people die, their family inherits their stuff, and there's been no formal procedure set in place to select a date that is 6 months after the date of death. So inevitably, for most people, we're going to default to the date of death. And what is an asset worth on the date a person dies? How do we establish that? Well, it would depend on the asset. Now, for vehicles, you have Blue Book. For the stock exchange, you just simply do a historical search for what stock traded for on a particular date on the stock exchange. For real estate, you can certainly hire an appraiser to come out. And I've even spoken to real estate agents who have a really good savvy idea of what a market is worth, who can value property. Now, what about those people who died after 2009 and specifically who died in 2010? If you inherited property from a decedent who died in 2010, special rules may apply for calculating your cost basis. There are two options for how executors could treat the assets in estates of decedents who died in 2010. And in that 1 year, the executors had a choice of following the rules that have always been in place historically or making an election to essentially report the value of the estate. And there was actually, that's the wrong way to term it. There was a one point in time where the death tax was supposed to be repealed. Do you remember that? It was part of the Bush Tax Act, one of his acts. Passed in 2001, and it was going to clock forward, and in 2010, for one short period in time, the death tax was going to be repealed. And that year was 2010. But by the time we got to 2010, there was legislation going on to repeal the repeal of the estate tax. And that was successful. But for those people who died in 2010, the administrators of their estates have a decision. They can go with the repeal of the repeal, or they can just go with the repeal. And so if they did that, then they elect out of the estate tax rules for 2010 and use the modified carryover basis rules under Section 1022. And that's a much more complicated methodology. So if you have a client who fell into that, it's probably because they had a very large estate worth more than $5 million. Property received in exchange for services rendered or barter. Generally, you must include the fair market value of property you received in exchange for services in your income. Your cost basis will then be the fair market value you included in your income for the year that you acquired the property, plus or minus any adjustments. So, of course, if you are doing barter of property for property, your basis in the property you receive is going to be your basis in the property you gave up, right? Plus boot if you had it. But the basis in property you receive for your services is going to be the fair market value of those services that you include in your income. So presumably if you trade, let me see, as tax preparers, have we ever in our lives once traded tax return preparation for something else? Try not to, but it happens. You know, it'll come up. I once traded tax return preparation for getting skylights installed in my house. The guy who installed the skylights thought he was getting an incredible deal. And believe me, I thought I was getting a great deal too. So in that arrangement, I should, at that time, which was close to, I don't know, 15 years ago or more, probably 18 years ago this happened, I was supposed to put the fair market value of the services rendered in installing those skylights into the revenue of my business and include that as income. And then I could step up the basis of my house by the amount that I had included in my income. That's the correct way. The question is, did I? And I shall not speak. I can't remember. It was too long ago. I know what I should have done. Oops. Well, I should have done it. Now, as tax professionals, we can never, of course, allow our clients to not do the correct thing because we can't be party to an inaccurate tax return. But I was just using that as an illustration for you. Of course, I reported it in my income because I'm 100% honest. Closing costs and other acquisition costs. If you purchase a home or other real estate, you will nearly always pay closing costs, and closing costs can include escrow, title, and recording fees, taxes charged on purchase, loan assumption fees, points, including discount points or loan origination fees, and points are generally a percentage of the mortgaged amount and are considered to be a form of prepaid interest. Other settlement charges you may have paid to acquire the property. And an illustration of how these closing costs add to basis is coming up a little bit later in this manual, so I'll show you there. Costs you might incur on the purchase of property other than real estate include sales tax, loan fees, title fees, and registration fees, which are obviously common with cars, but you can pay them on other asset acquisitions as well, and then delivery and installation charges. So for example, if you have a customer who purchases an assembly line, there's going to be the direct cost of purchasing that assembly line, the equipment itself, but I'm sure that delivery and installation is going to be a major component of that cost as well. And IRS says that all of the costs associated with paying for the equipment, having it delivered, having it installed, any taxes you might pay on it, any delivery charges you might pay on it, those all are considered to be a part of the cost, and they should be added to the cost. Next up, adjusted basis of property. Adjusted basis is the cost basis of your property plus or minus any of the following. Amounts you invested into your property to improve its value, add to, or extend its useful life. Amounts you claim as a tax credit or tax deduction upon the acquisition of your property. Postponed gains from the sale of your home. If you can remember back that far, we used to do that. Postponed gains from the like-kind exchange. Amounts you claimed or are presumed to have claimed for depreciation on property you used for business, and any other amounts you receive in relation to the property that have not been previously reported in your income. So I have a table here. On one side we have things that increase basis in property, and on the other side we have things that typically reduce the basis in your property. And on the increase, we look first at capital improvements, and these include things like putting an addition on your home, replacing an entire roof. Rather than just repairing the roof, you replace the entire roof, rip it off and replace it. Paving your driveway, installing central air conditioning, rewiring your home. So if you have a home, and I had a home like that once, that you buy it and it was built in the 20s sometime and it's full of this old knob and tube wiring, so you rewire that whole house, well, that's going to improve the value of the house. It's also going to improve the life of the house. So even though it's an internal thing that might seem to be like a repair more than an improvement, it is considered to be an improvement. Assessments for local improvements, such as the city comes in and hooks your house up to water, or puts in a sewer system, or adds sidewalks, or even paves the road in front of your house so that you go from gravel to pavement. All of those items improve the value of your house and add to its cost. Casualty losses, the cost of restoring damaged property to its original condition or even above and beyond its original condition, or even to something less than its original condition, is all going to add to your basis. Legal fees, the cost of defending and perfecting a title, fees for getting a reduction of an assessment. Those are examples of legal fees that would add to your cost in property. So let's think about it this. You purchase a vacant lot, and then there comes to be a dispute between you and a neighbor over exactly where the boundary line is. So you hire an attorney to represent you, and you go to court, and finally a decision is made on who owns what piece of land and where the boundary is. All of the legal fees you incur to establish that become part of your cost basis in that land. Zoning costs are also things that add to basis. Taxes and interest paid on unimproved real property, but only if the election to capitalize these costs is made. And finally, real estate taxes, mortgage interest paid on behalf of the seller. So you are a buyer and you pay debt owed by the seller. The debt that you pay for the seller adds to your basis in the property. That's what that's saying. So let's look at things that decrease basis, and one of those is Section 179 deduction. We're going to cover depreciation and Section 179 deduction on Tuesday next week. Deduction for clean fuel vehicles and refueling property. Non-taxable corporate distributions, that's a return of your cost. So when you get a 1099 DIV that shows non-taxable, I think they're called non-taxable dividend distribution is on there, that's a reduction in your cost basis in the stock you own. It's not a capital gain to you at the time, but it does reduce your basis. Deductions previously allowed or allowable for amortization, depreciation, and depletion. Exclusion for subsidies for energy conservation measures, and credit for qualified electric vehicles, postponed gain from the sale of a home, investment credit, part or all that was taken, casualty and theft losses and insurance reimbursements, certain canceled debt excluded from income, rebates from a manufacturer or seller, easements, and tax credit or refund for buying a diesel-powered highway vehicle. Those are all things that can add or decrease your basis. Amounts spent to improve or extend the useful life of property. An amount that a person or a business spends to improve or extend the useful life of property is one of the things that does confuse my clients a great deal, and I've also noticed that it all confuses a lot of my tax preparers. So I've been doing taxes for 20 years. I've supervised literally hundreds of preparers, and I can say that both tax preparers and clients are confused by basis. It's something that a lot of people just have a hard time grasping. And the reason is that people think that when they make an expense, pay out an expense, that there should be some way to claim a deduction for that. And I'm sure we've all sat in our office and we've had the client come in who's got their new home, and they sit down with all of the receipts that they've saved for the year for all of the things that they did to their house, and they think somehow, some way we're going to put those on their tax return as a deduction. And the answer that I give them is, I'm glad you saved those receipts, put them in a box, and save them forever. Because you never know when we are actually going to have to figure out the cost basis of your property. They're not deductible now, but they do add to your basis, assuming that they are improvements, and we never know what the tax code is going to say 10 years from now when you sell that house. Right now we have an exclusion on the gain on the sale of your house. If you sell your house, you can exclude up to $250,000 of gain if you meet those tests. But that rule only started in 1997. Prior to that, if you sold your house at a gain, you had to pay tax on it. So I always say, hang on to everything. We also had a situation where real estate was climbing dramatically all over the country right up until 2008 when the crash came. Real estate was rising dramatically, and it was possible in certain parts of the country to live in a house for 5-10 years and have that $250,000 gain, maybe $300,000 gain, and sell and have a realizable profit that you have to pay tax on. So that would be another reason to hang on to those receipts, but not at the time we're preparing the tax return because you just happen to have an expense during the year. So while the law does allow certain instances when a current year deduction can be taken, such as my client installed brand new high efficiency windows, or put on a heat reflective coating roof, or installed geothermal heat, or put in a wind turbine to provide electricity for the house, those are examples of expenditures that are allowed an instant deduction or credit on the return, but most of the time nothing like that is allowed. And of course, if they are allowed to claim that deduction or credit, what happens to their basis in the house? Well, they would increase the basis of the house by the amount spent on the improvement, and they would reduce the basis by the credit or deduction claimed because of the improvement. So it's two things happening at the same time. Now here's an example of how we figure basis when we purchase a house. You purchased your home for $200,000. The closing costs that you paid when you acquired the home include the following. There was the purchase price at $200,000, and you paid title and recording fees, title insurance, and a variety of other closing costs that totaled $500. You add up each of these items and add them together, and you get your cost basis in that house. Now, at the time the house was purchased, there was also a loan origination fee paid, and there was a proration of property taxes that were paid. And these are property taxes prorated for the buyer of the house based on the buyer's liability for those taxes. And if the buyer owes the taxes and pays the taxes, then the buyer deducts those on Schedule A. And the loan origination fee is an example of something that the buyer of the house can also deduct on Schedule A. So to calculate your basis in the home, subtract the deductible closing costs from your acquisition cost. So typically you would be looking at the closing papers, and the closing papers are going to show the purchase price of the house. They're going to show all of the other closing costs associated with the purchase of that house. And our job as tax preparers is to go through the list of all of those numbers all the way down the page and leave in the ones that add to basis and throw out the ones that do not add to basis to arrive at a net number. And in this case, that net number is $206,100 of amount that was paid for the house, but of that, $203,100 adds to basis and is considered to be basis. So the closing costs of the house are this, but the amount that adds to basis is that. Now, after you've purchased your house, any future amounts that you spend to improve or extend the life of the home add to its adjusted basis and are typically referred to as home improvements. I'll give you some examples of home improvements. They include things like room additions, adding a second story, installing a new roof, fence, deck, or patio, even a driveway, remodeling one room or the entire house, rewiring, replumbing, recarpeting, residing, or other similar improvements, adding or replacing fixtures such as appliances, lighting, doors, etc., city or county assessments for roads, sidewalks, sewers, etc. These home improvements add to your basis and increase your adjusted basis. So they add to your cost and increase basis. But here's some things that can reduce or do not increase the basis of your house. These are everyday repairs, and they do not add to basis. Repairs such as fixing a broken lock or a hole in a leaky roof. Maintenance costs such as mowing and maintaining your garden, cleaning your carpets, spraying for carpenter ants, cleaning your chimney, etc. The cost of refinancing your mortgage, and insurance premiums. None of those add to basis. One of the things my list doesn't have, which is rather important, I don't see it here, is landscaping. Now, when you're maintaining your yard, you've got the landscape people that might be coming out and mowing the lawn, or you could be doing it yourself. Each summer you might, or each spring you might be planting the annuals in the garden. I would call those maintenance costs. But if you decide to put in a retaining wall, you decide to put in a patio, you decide to plant some perennials and trees that are going to remain with that property, grow with that property, those are things I would call improvements. Next up are tax deductions and credits claimed upon the acquisition of property. If you claimed a deduction or credit because you acquired property given special treatment under the law, you must subtract the amount deducted from your income or credited against your tax from your cost basis. And I did mention this earlier, but we're going to take a little bit closer look at it. Examples of the types of deductions you might be able to claim include points on a loan to purchase or improve your main home. Points are paid at the time you buy, and you saw in the illustration we just did that they don't add to the basis. They're deducted at the time. The Section 179 deduction for property you placed in service for your business, or depreciation or amortization deductions on property you use for your business. Examples of the types of credits that you might be able to claim include the credit for qualified electric vehicles, business credits allowed for the purchase or development of property, including purchase and or installation of certain energy efficient devices, advanced energy projects, rehabilitation projects, and disabled access expenses paid by a small business to comply with the Americans with Disabilities Act. Depreciation and amortization. If you previously claimed or should have claimed depreciation from your business asset or on your business asset, you must subtract any depreciation allowed or allowable from your basis in your property. Now, here's the thing about depreciation, is a lot of tax preparers and tax clients alike seem to think that depreciation is, well, optional. I see enough tax returns over the years that the tax preparer did not claim any depreciation on a rental house. or that there is there's a business, the person's self-employed and they have assets in their business and there's no depreciation schedule. So the depreciation is something that the IRS says you have to take. Well, let me put it another way. You will be treated as if you've taken it, even if you didn't. So when it comes time to sell an asset, if it's an asset on which depreciation was allowable, even if you didn't claim it, your basis is reduced by the amount of depreciation you could have claimed. So customers, we've had customers, they just don't want to do depreciation. Do I have to depreciate it? I don't want to have to pay that extra tax when I sell it. I don't want to depreciate it. The answer is, well, I won't depreciate it for you if you don't want me to, but when you sell it, you're still going to have to pay that tax as if you had. So it's not an optional thing. Session 14, password number 1 is OAK, O-A-K. Postpone gains from the sale of your home. How many of you can remember when we were doing that? Postponing gains on the sale of our homes. It's been a long enough time ago now. 1997 was the last year we had to worry about trying to postpone the gain on the sale of our home. But there was a point in time where if you bought your home and you lived in it and then it went up in value and then you sold it and you were selling it to buy another house, you could roll over the gain from the sale of the old house into the new house and not have to pay tax at the time of that sale. And the rules were that you had to live in the house, or you had to buy the new house, I think, within 2 years of selling the old one. There wasn't an occupancy requirement that you had to live in it for a minimum amount of time. It was just that the replacement house had to cost as much as the old house or more than the old house, and you had 2 years in which to buy it. And if you met those conditions, you could postpone your gain. Well, IRS says that the gain you postponed reduces your basis in the new house. And we'll talk more about that particular rule and how it worked in another course we offer, which is, I think, like-kind exchanges. In that one, we have sale of home and like-kind exchanges in that class, and it's a week out, I think. Here it is. Yeah, installment sales and like-kind exchanges. It's in that one. It's actually sale of home, installment sales, and like-kind exchanges, but that's just too long a title, so we call it installment sales and like-kind exchanges. But that's where we talk about it. Postpone gains from like-kind exchanges of business or investment property. If you previously elected to postpone the gain on the disposition of your property because you traded that property for like-kind property, you have to reduce your basis in the new property by the gain that you don't have to pay tax on the disposition of the old property. And again, we'll talk about that in an upcoming class. Important rules relating to the basis of real estate. There are a number of common events that affect the basis in real estate, and IRS rules for these events are described here. So I've tried to make these as clear as I can. If you look at this sentence, it says real estate taxes paid for the seller by the buyer. The opposite of that would be real estate taxes paid by the seller for the buyer. So in this situation, the first one, we have real estate taxes that are being paid for the seller by the buyer. If you paid real estate taxes owed by the seller of a property as a part of the purchase cost of the property, you add the taxes that you paid for the seller to your basis in the property. You cannot deduct them as taxes paid on A, C, or E. And if you are the seller and pay taxes for the buyer, you add the amounts to your basis or to costs of sale. Sometimes when you're selling property, let's just say you're selling a vacant lot. Your closing papers from the original purchase are going to have how much you paid for it plus all the closing costs. And then when you sell it, your closing papers are going to have what you sold it for plus all of your closing costs. And the rule is that you're going to sell it for the sales price, and all of the closing costs that you pay on sale will add to your cost. So they're not subtracted from the sales price, but rather they're added to the cost basis. And it's just a matter of where you put it on what used to be the Schedule D and now the 8849, where you put those amounts. So if you are the seller and pay taxes for the buyer, you add the amount paid to your basis. The buyer deducts the taxes as appropriate on Schedule A, C, or E. You do not deduct them on Schedule A, C, or E. And the opposite of that is real estate taxes paid for the seller by the buyer. If you pay real estate taxes owed by the seller of a property as a part of the purchase cost of the property, you add the taxes you pay for the seller to your basis in the property, and you cannot deduct them as taxes paid on A, C, or E. Settlement costs which add to the basis of property. The IRS does have very specific rules in its publications on what kind of settlement costs add to basis and which ones are not considered to add to basis. And those rules do vary according to whether you're talking about personal use property or business use property. A fee paid to buy property is a cost that must be paid even if you bought the property for cash. So we're looking at settlement costs which add to the basis of property. And in that, you include settlement fees and closing costs in the basis of the property you buy. And when we're looking at settlement fees, a fee paid to buy property is a cost that must be paid even if you bought the property for cash. So it's not associated with a loan. If I pay a fee only because I'm getting a loan, then it's not a settlement fee. It would be a loan fee. And how IRS treats loan fees and settlement fees is quite different. So a fee paid to buy property is a cost that must be paid even if you bought the property for cash. And the following items are some of the settlement fees or closing costs you can include or add to the basis of your property. We have charges for installing utility services, legal fees including search and preparation of the sales contract or deed, and recording fees. Also surveys, transfer taxes, owner's title insurance, and any amount that the seller owes that you agree to pay, such as back taxes, interest, recording, or mortgage fees, charges for improvements or repairs, and sales commissions. Next up, we have loans and other costs that do not add to the basis of the property. Do not add these items to basis. Costs and fees paid for getting a loan on the property or amounts placed in escrow for the future payment of items such as taxes and insurance. Well, up earlier, we had this illustration with the red and green arrows. Let's get to it again. We had costs that are deductible on Schedule A, and one of those is property taxes. Now, most of the time, but not all of the time, but most of the time when you buy a home, there is the option at the time you buy the home to pay a monthly amount into escrow. Escrow is used for a couple of items typically. One is property taxes and the other is insurance, because most lenders require that you have insurance on the home and that you keep your taxes up to date, and they'll typically want you to put into an escrow that they manage. And when those payments are due, the lender takes the payment from escrow and pays those obligations for the owner of the property. When you take money or come to the closing table on the purchase of a home, one of the items you bring to close is cash to put into escrow. Some of that escrow is going to be taxes, and some of it typically is going to be insurances as well. And for some people who have homeowners association dues, there could be an escrow account for that too. Whatever amount you put in at close, and it will show up on the closing paper as such, that doesn't add to your basis. And it's not a loan fee either. So let's look at some examples of loan fees. They include points, mortgage insurance premiums, loan assumption fees, the cost of getting a credit report, fees for an appraisal required by a lender, and fees for refinancing a mortgage. All of these fees are obviously costs associated with purchasing a home, but the IRS says you may not add them to basis. Escrow items. The following items are examples of settlement fees and closing costs you cannot include in the cost basis of your property. Fire insurance premiums, rent paid to occupy property before closing. I had to do that once. I remember that being on my closing papers, and I've seen it other times. You know, you're closing after you actually move in. You've bought the house and there's, hey, I'd like to move in now even though we're not going to be able to close for another 3 weeks. Can we move in now? And it's customary to charge rent for that period of time, that window of time. And then it will show up on the closing papers. And then charges for utilities or other services relating to occupying a property before closing. Loan and escrow costs paid to acquire business use property are treated somewhat differently. So if you're paying these expenses up here, loan fees in association with buying your personal home or a residence, these will not add to your basis. But if you're purchasing it as a business asset, there is some different treatment. If you pay loan or escrow costs relating to business use property, you should capitalize and deduct these costs as follows. Loan fees are capitalized and amortized separately from the property being purchased. So in essence, you should have two different lines on your depreciation schedule. One for the property that's being purchased, the cost in that property, and the other one for the loan fees associated with purchasing that property, and how they are depreciated is quite different. Here's an example. The purchase price and closing costs of a residential rental property are depreciated over 27.5 years, but the loan fees paid to purchase the rental property are amortized separately over the life of the loan. Typically, most loans are 30 years, but it could be a 10-year loan, a 20-year loan, a 15-year loan. Whatever the life of that loan is, that's going to be the amortizable life of the loan. Here's an illustration. A rental house is purchased at a cost of $120,000. $100,000 is allocated to building or to the building and $20,000 to the land. Loan fees paid on acquisition of the property totaled $3,000. So we look at the depreciation schedule here, and we have the asset description, we have the building and the loan fees, and we have the cost paid for each piece of property. $120,000 for the building and $3,000 for the loan fees. We're not allowed to depreciate land, and so we're going to look at the depreciable property of, or the depreciable basis of that building as being $100,000, and it will be depreciated over 27.5 years. And the depreciation deduction allowed in any particular year should be $3,636. But if the points or the loan fees associated with purchasing that property are $3,000, and it's a 30-year loan, then we're going to end up with a rate of amortization of $100 per year. Insurance, premiums, and property taxes paid from an escrow account for the cost of keeping a rental home are deducted on Schedule E. So escrow items are deducted as part of the operating costs or operating expenses at the time payment is made from escrow. So we talked about money going into an escrow account, and if it's going into an escrow account for your personal residence, and it is a deductible item like real estate taxes, then when it comes out of escrow and pays those real estate taxes, you'll be able to deduct that on Schedule A. But if it's an escrow account set up for a business, then, and the business is, say, a rental property, then at the time escrow expenses are paid out for taxes and insurance and even homeowners association dues, those are all allowable deductions on the Schedule E for the rental property. Next up is the treatment of loan and escrow costs on personal use property. Loan fees and escrow costs relating to the purchase of your home do not add to your basis in the home. If you paid points on the purchase of your home or made escrow deposits to pay property taxes, these are deductible on Schedule A in the year paid. There's a special rule here, and it's one that I've known about for many, many years. I've even done it with clients over the years, and that is the election to capitalize mortgage interest and property tax on unimproved real property. Now, one of the things that we did cover a little bit ago in this series was what happens if you take out a loan to purchase a vacant lot. You are allowed on Schedule A to claim mortgage interest deductions for your home, for your residence. And that home can be a vacation home, it can be your full-time home, it can be your motor home, it can be a travel trailer. It's something that you live in. That's what makes it your home. Vacant land is not your home, it's land, okay? And because it is not your home, the interest you pay on it is not deductible as home mortgage interest. It's possible that you can deduct it as investment interest, but your deduction for investment interest is limited to your investment income. So if you don't have a lot of investment income and you have a lot of investment interest, which you might have on a vacant lot, you're ultimately going to be having to limit your deduction each year and keep carrying forward that investment interest until some point in the future where you might have investment income. The alternative is to say, out of heck with that, I'm just going to capitalize the interest and not worry year to year about what I'm allowed to deduct or what the carryover might be. But if you want to make that election to capitalize your interest and or property taxes on your real estate, you have to attach a statement to your return to do so. And the IRS wants it to be the original return for the year you acquire that property. So they don't want you making an election 10 years into ownership, the first year you own that property, and it comes time to make a decision, am I going to deduct the real estate taxes on it, because those are deductible year to year, except under AMT. That would be a very good reason to capitalize taxes. If you are subjected to the alternative minimum tax, you are not allowed to claim a deduction for real estate taxes. So that would be an excellent reason to capitalize. If you don't make the election to capitalize your interest, and so you are carrying it forward each year until you sell, in the year you sell, you can claim the interest at that point, can't you? And the answer is yes. You would need to make an election in that year to have your capital gain income treated as investment income. Capital gain income is taxed at a rate of the lower rate of either 0 or 15% in most cases. And if you made an election to not capitalize the interest. Actually, not capitalizing the interest is not an election. Capitalizing it is an election. So if you didn't make the election to capitalize, then you're supposed to be deducting it over the years. And if you can't because you don't have enough income, then you're carrying it forward each year. And I think it's 4952 is the form you do it on. It's one of those forms I have a hard time memorizing. But anyway, you carry it forward each year until you sell. Now, in the year you sell, you'll have a capital gain, presumably. But what if you have a loss? So if you'd been adding it to the basis, it would increase your loss. But if you get to a point where you sell at a loss, you're still carrying forward investment interest until you get to a point where you can have income, investment income. So capitalizing can be a good idea. Now, amounts you received in relation to your property is the next item we're looking at. If you have received financial or tax benefits in relation to your property that were not included in your income in a prior year, you must subtract these items from your basis. And examples of these benefits include a rebate received from a manufacturer or seller upon the acquisition of property. This seems to me to be an example of a really good test question. If I were offering up a test, one of the questions I think that I would suggest is, I received a rebate of $100 when I purchased my television. How much do I have to include in my income? The answer is 0, but I do have to reduce the cost in the television by $100. So rebates from a manufacturer or seller on the acquisition of property are merely a reduction to cost. They are not income. Forgiven or canceled debt when a loan that is on a loan that is that the asset secured. So if you have an asset and the debt on that asset is forgiven or canceled, whatever amount of debt was canceled subtracts from your cost basis in that asset. That makes sense. Insurance reimbursements you received from a casualty or theft loss, and tax deductions you claimed for a casualty or theft loss also reduce your basis. The next item we're going to talk about is a fairly complex one, and I'm not going to spend a lot of time on it, but it is really worthy of a separate discussion all in its own, and that is the Uniform Capitalization Rules. Essentially what they boil down to is IRS says that if you can capitalize something, we want you to capitalize it, and we don't want you to deduct it instead. So let's see what they are talking about when they say that. The Uniform Capitalization Rules require you to add certain costs to basis in certain circumstances. The term capitalize means to include certain expenses in the basis of the property you produce or in your inventory costs rather than deducting them as a current expense. Capitalized costs are recovered through deductions for depreciation, amortization, or cost of goods sold when you sell or otherwise dispose of the property. Activities that are subject to these rules: you must use the Uniform Capitalization Rules if you do any of the following in a trade or business or for other activity that is carried on for a profit. You produce real or tangible personal property for use in or for business, for use in the business or activity. I'm having a hard time today. So what would that mean? You run a manufacturing company and you produce furniture. That's the manufactured item. Well, the IRS says do not deduct the costs of manufacturing that item as an expense. All of the costs associated with the manufacturing of that item, including labor, materials, delivery costs, taxes, insurances, utilities, they all add to the cost. How much did it cost me to manufacture this item? Well, it cost me far more to manufacture it than the raw material that I purchased. I also had the cost of paying labor to manufacture it. I had the cost of the assembly line. I had the cost of the utilities to drive the assembly line. I had all of these costs. And under IRS rules, you don't just expense them. Instead, you put them into the cost of the property. And if it's an inventoriable item, then it becomes part of your cost of goods sold. The other side of the equation is that you are maybe making a film, making a movie. And you've got all of the cost of the actors, the transportation, the camera crews. You're producing an item that you're then going to license out and sell. But that item itself is itself not sold, right? The rights to watch it are sold, but the asset itself retains its value. So for example, if you own the rights to The Lord of the Rings, you have something that's worth a lot of money. And over time, that asset could continue to produce revenue for you and you don't sell it. People are paying you for that. So the IRS is saying all of the costs that went into the manufacture of that item have to be capitalized and they don't get just deducted as an expense. So what activities are subject to these rules? Let's go back and read this first item. Produce real or tangible personal property for use in the business or activity. Produce real or tangible personal property for sale to customers. Acquire property for resale. You produce property if you construct it, build, install, manufacture, develop, improve, create, raise, or grow the property. Session 14, password number 2 is harbor, H-A-R-B-O-R. Tangible personal property includes films, sound recordings, videotapes, books, or similar property. And under the Uniform Capitalization Rules, you must capitalize all direct costs and also an allocable part of most indirect costs you incur due to your production or resale activities. Any cost you cannot use to figure your taxable income for any year is not subject to the Uniform Capitalization Rules. Now, when we get to the Uniform Capitalization Rules, there are some exceptions. The following are not subject to these rules. Property you produce that you do not use in your trade or business or activity conducted for profit. Or certain qualified creative expenses you pay or incur as a freelance, self-employed writer, photographer, or artist that are otherwise deductible on your tax return. Property you produce under a long-term contract except for certain home construction costs. Research and experimental expenses allocable or allowable as a deduction under Section 174 of the Internal Revenue Code. Costs for personal property acquired for resale if you or your predecessor's average annual gross receipts for the 3 previous years did not exceed $10 million. So what that's saying is most small businesses don't have to follow the Uniform Capitalization Rules because their gross receipts are going to be less than that. So the Uniform Capitalization Rules are there and businesses are supposed to follow them, and when you get into large businesses, they are required to follow them. But with small businesses that lack the accounting capacity or the knowledge or skill to even begin addressing it, the IRS says you don't have to. Also, do not capitalize certain costs that are not deductible as ordinary operating expenses, and an example of a non-deductible expense is the 50% of meal and entertainment limitation. So what that's saying is you have the expense for meals. Let's suppose you had $1,000 of meal expense during the year. You're allowed to deduct $500 of it because that's the limit. You do not get to capitalize the $500 that was not deductible. It's just not allowed anywhere. For other exceptions to the Uniform Capitalization Rules, you can refer to this section right here. For information on the special rules that apply to the costs incurred in the business of farming, read Chapter 6 of Publication 225, Farmers Tax Guide. Farmers are a group that do have to follow the Uniform Capitalization Rules more often than other types of small business. And then for more information about Uniform Capitalization Rules, see the regulations under Section 263A or Publication 538, Accounting Periods and Methods. All right, so we're on to the next topic of the day, which is why can I be bothered to track the basis of personal property? It's a hassle. I've been in my house now for 12 years, and I've been saving receipts for 12 years. How long do I have to save them? Can't I start throwing them out? That's a typical question I get. And the answer is if you live in that house for 40 years, you need to save your receipts for 40 years plus 3 years after you sell, because 3 years after you sell is typically the time frame where the IRS would audit you, right? So they're not going to audit you on the basis of your property until you sell it. And at the time you sell it, you have to be able to prove what your cost is. And the longer you own it, the longer you have to maintain that proof for. So that is one of the things that also gets people confused, because the IRS says you have to hold on to your tax records for 3 years after you file your return. And people translate that to be, well, I bought the property in 2009 and it's now 2012. I guess it's safe to throw out the receipt because it's been 3 years. But there's the lack of comprehension that the purpose of holding a receipt is to prove a cost at the time you claim that cost on your return, and you may not be claiming that cost for many years down the road. So since the law does not allow you to claim a deduction for the improvements of property, why do you keep it? Well, the first one is you may eventually sell it, as I've said, and especially when we're talking about real estate, you can hold that for many, many years, 20, 30 years. and you're supposed to hang on to the receipts the whole time. The other reason is there could come to be that day where you decide to convert your personal property to business use. Either you have some office furniture that you acquired a few years ago and you've decided to go into business for yourself, and so you convert that office furniture to business use, or you have a home that you've lived in for a number of years and you decide you're going to turn it into a rental. Now we need to know what the cost is for that, including all of the improvements for the years that you've owned it. The next topic we're going to take a look at is the basis in stock. Stock should be simple. You buy it, you hold it, you sell it. You pretty much have a brokerage account telling you when you bought it and what you paid for it. And then you have another brokerage statement telling you how much you sold it for, so how could the basis of stock be that complicated? Well, actually, it is kind of a mess. Sometimes it is done perfectly. You'll have a statement that does show all of your stock purchases and all of your stock sales very nicely, but just as often there's pieces missing. And our job as tax preparers is A, to notice that a piece is missing, and then B, work with our client to find that missing number or numbers. But in general, you count or calculate your basis in stock in the same way that you calculate basis in other types of property. However, the sale or disposition of stock is often subject to special treatment, so it's important to be aware of some of the special rules that affect the sale of stock. The most confusing aspects for many people is determining the acquisition date and price of the stock. I say that just from experience. My clients don't seem to remember when they bought their stock or how much they paid for it. If they've got a brokerage house, possible that brokerage house has kept that record for them, but just as often they started with one broker, transferred to another broker, and that information didn't transfer to the other broker, and the new broker is saying, well, it's the investor's responsibility to maintain those records, and the investment says, no one told me to maintain those records. Or even if I was told to maintain them, I thought that, I've had them for 10 years, time to get rid of them. So these things do tend to disappear. And so I often get the deer in the headlight look when I ask my clients how much you paid for this stock and when you bought it. They just simply don't know. Now, there are possible different methods for acquiring stock, and these include just outright purchasing it, also getting it as a gift, inheriting, divorce. My spouse owned it, I divorced him, and I got half of everything he had, including half of his stock portfolio. Employee incentive stock options, or ISOs, employee stock purchase plans called ESPPs, and employee stock awards, or RSAs, as well as restricted stock units, RSUs. Now, in the world of what I deal out there as a tax professional, what do I see the most of? I see the most of these RSUs and ESPPs, and I see quite a bit of this one here, and clearly a lot of this one up here. The gift one comes up occasionally. The divorce one, I've had that too. To get a client that worked for, let me see, her husband worked for Nike, and he had stock that he'd been awarded years and years and years ago. And then when they got divorced, she got it all. That was a lot of work, going back and forth to him, figuring out how much he had as a basis in that. Purchase of stock. If you purchase stock, you should keep accurate records of purchase dates and the number of shares of each kind of stock you bought. Most investment companies keep computerized records of your transactions. However, if you switch to investment companies, those computerized records do not typically follow you. Now, there is a new rule in play that the IRS is saying it is now the brokerage house's responsibility to track basis and report it to the IRS. Now, a lot of brokerage houses have been tracking basis for years anyway without having a requirement to do so. It's been more of a customer service issue. That's why they've been doing it. But it's come to a point in time where now the IRS has essentially said, brokerage houses, you have to track basis. You have to record it, and you have to report it to us each year. Well, the first year that requirement came into play was this year. So for the first time ever, we saw clients getting 1099-Bs, and they never look like this, but this is the standardized format that IRS publishes. I'll just zoom in on it a little so you can see it bigger. And it's got, of course, a series of boxes. On the left side, it's got the information relating to the payor and the recipient. And then we go over and look at the boxes themselves, and we'll see we have the date of sale or exchange, and for the first time, we have the date acquired. There's never been a requirement in the past for the date stock was acquired to be reported to the IRS. So this is the first time in history the 1099-B has had a line for that. Also on line 2, we have the sales price, and then we have a notation made on that sales price. Was the sales price, or was it the sales price less commissions? And most brokerage houses report the sales price less commissions, so that's the box they'll check. But from a preparer standpoint, that's relevant, because if the sales price reported to IRS is less commissions, then we do not add those commissions to the cost of the property. But if the sales price was reported in full, then we do add it to the basis of the property. So in general, all of the costs associated with the purchase of property are added to its basis. And also when you sell property, costs associated with the sale are costs of sale, and those are treated as part of our cost basis. We typically don't reduce our sales price by selling expenses. But some brokerage houses, what they do is they do report the reduction in proceeds and report only that reduced amount. So we have to be on our toes and watching to see what happens. But brokerage houses with the sale of stock typically are going to report proceeds less commissions. Then we have box 3, cost or other basis. This is a brand new box, never been there before. Now, if there's a number in box 3, there would typically only be a number in box 3 because the stock that was sold was purchased in 2011 or a later year, because this basis reporting requirement starts in 2011, which means any stock acquired before 2011 does not need to have the basis reported to IRS. As we pass through time and go over time, over the next 10, 15 years, we'll eventually, presumably, get to a point where most cost basis in most stock is being reported to the IRS at the time of sale. But as we sit here right now, we're only seeing basis reporting for stock that was purchased in 2011. So if box 3 is blank, then usually box 6 will be checked. Box 6 says if this box is checked, boxes 1B, which is the date of acquisition, 3, the cost basis, and 8, whether it's short-term or long-term, may be blank. Now, there is a terminology for this that the brokerage houses are using, and they call these securities either covered or non-covered. What does covered mean? IRS knows about it. Yeah, it's reportable. It's a covered security because it's covered under the law. It's covered under the law because it was purchased in 2011 or a later year, and because it's covered under the law, we're reporting the cost basis, the date of acquisition, and whether it was long-term or short-term. A non-covered security is a security that was purchased before 2011, is not covered under the law, and therefore the basis does not have to be reported to the IRS. When that's the case, box 6 is checked, and all of these other boxes are blank. All right, so let's move on to the next topic, which is gifted stock. Now, I explained that gifted stock is a little more rare than inherited stock. Most people that get stock either buy it or inherit it, or they get it through their job. There's not a lot of us walking around who just get given stock. Over the years, I have had clients who were gifted stock. I had one young man who was given stock in Disney. It was pretty interesting. It was a certificate with Disney stuff on it, like Mickey Mouse and stuff. It was really cool. Had another young man who was given stock in, what is it, Pittsburgh Steel Company. His grandfather bought it for him when he was born back in 1966. So there is some of that that goes on. And what happens if you receive stock as a gift? Well, if you receive stock as a gift, you should ask the person who gave you the stock for their records on the original purchase. So if your parents gave you stock, the first thing you should do is say, hey, thanks, Dad. Can I please have your record of purchase? I need to know how much you paid for the stock, Dad. I need to know how much your gift cost you. So you do have to look that gift horse in the mouth directly. So your basis for calculating loss or gain on the sale of gifted stock will depend on whether the fair market value of the stock is less than, equal to, or greater than the donor's adjusted basis at the time of the gift, all those same rules that we looked at the very start of class. If the person or entity that gave you the stock does not have accurate records, try to get an accurate purchase date. You can consult periodicals and other reference sources to determine the fair market value of a particular type of stock issued if you have the following information. Now, of course, one of the things IRS does say is that if you can't show that you have a basis, then they'll assume you don't have a basis. So how do you show a basis in stock, for example, Pittsburgh Steel Company, that was given to you by your grandfather who died 20 years ago? and all of the records he may have had at one point are lost. How do you show that? How do you show you have a basis? Well, the only thing you're going to have to go on is the assumption that the grandfather could not have received it for free. He had to have a cost in it himself, and if you know he purchased it at the time you were born, it's a matter of figuring out what it traded for around the time you were born. Is the IRS going to accept that? They could. They could also say no, but you've got to give it the best shot you can, and the IRS does look at testimony, and obviously what is reasonable, and it's not reasonable to expect that stock of value has no cost to anyone anywhere at any time. But what happened with my client who had this stock in Pittsburgh Steel Company is we actually consulted periodicals. At that time, it was before the internet allowed you to look stuff up. And even if you can look it up on the internet, it typically stops at the 10-year point, and we were going back, a lot farther than that. So what could we do for that stock basis? I had people looking in the periodicals division at our library. There were volunteers there back then who would do that, and they were coming up dry, just nothing. So I finally decided to call directory assistance in Pittsburgh and get the phone number for Pittsburgh Steel, and I called them, and I explained to the receptionist what it was I was looking for. And a day later, I got a call from a vice president at Pittsburgh Steel, who's a very, very nice lady, and she told me what that stock traded for back in 1966. So that's what we went with. And if you have an actual stock certificate with a date issued, I don't know if they put that on there, that would be something to look at as well. Since I've never been given stock with a nice, pretty certificate, I really honestly don't know what they look like. When we're looking at determining the cost basis in gifted stock, you obviously have to look firstly if you can actually get the record of purchase. And if not, you can go to the purchase date, the number of shares purchased, the name of the mutual company or the mutual fund, the number of stock splits that have occurred since the stock was issued, and you also have to be aware of any valuations of any shares that were allocated to a new spin-off company. Now, there are two ways that I have discovered to look up information. The first and easiest way usually is to go to bigcharts.com, and I'm just going to share my screen here for a second, and we'll go take a look at big charts together. But if I do a search engine here for big charts, see, I've been there before. It goes back 10 years. If you want to go back farther than 10 years, it's possible, but you really essentially have to be subscribing and paying money for that level of service. But even if you're not paying money, you can still go back the 10 years. So in order to go back 10 years, we have to go to historical quotes. Click on that. And then you need to have the symbol. I don't typically know the symbol for something without looking it up first. So typically, okay, I want to look up the value of stock, and I have the date. All right, so here we have the stock for Dell. And if we have the date that Dell was acquired, we can go figure out what that traded for on the market. And we can do the same system when we're looking at valuations for a person who has died and we're dealing with inherited stock. Now, this year, I seem to have a rash of people coming in to do tax returns that had big portfolios of inherited stock. And what I found interesting was that the brokerage houses were issuing 1099-B statements showing cost basis, or they were not issuing the 1099-Bs, but they were showing the supplementary statements to show the realized gain and loss for the seller, and those statements were showing the decedent's cost. And the brokerage house knows that you're supposed to use basis on the date of death or 6 months later as set by the estate, that the decedent's basis has absolutely no bearing for the person inheriting. And we're at a point right now where in some cases the decedent's basis is higher than current market conditions at the time of death were, because the stock market does this. Most of the time, if a person's held stock for a long time, when they die, it's worth more than they paid for it. So there's this stepped up basis that goes with it. But sometimes the decedent pays more and the basis actually drops. And this year I had a client and he came in and I'm working on his tax return, entering all of this stock basis in as I'm going through looking at all of his records, and somewhere in the conversation it came up that this was stock he'd gotten from his mom. This is inherited stock? Well, when did she die? Well, I can't remember. It was a couple of years ago. Okay, so I got her name, and I actually did an internet search for his mother. And yeah, she popped up, the date she died, her obituary and everything. So I said, oh, well, here's her date of death. That was easy enough. So then I said, well, we can't use these prices that are on your brokerage statement here, we need to go look up the valuations on the date of death. And he had pages and pages and pages of them. And so I looked up one, and it was completely different than what was on the statement. I looked up another. It was a match. I looked up a third. It was different. And I said, well, we need to go through and revalue all of these. The easiest way to do it is to go back to the brokerage house, give them the date of death, and have them do it for you, because they will do that. But it might take them a few days, and here we are 1 week from the end of the tax season. I can do it for you, but this is going to be a lot of work. Interestingly, in his situation, the stock was higher for basis to his mother than it was on the date of death, and so his cost basis was going down, but then when he sold, the basis was actually up, so he was realizing these profits on the tax return I was preparing that were higher than what was showing on the statements. And he didn't like that at all, so he took his stuff and left and never came back. So he deliberately decided to file a fraudulent return because he didn't want to accept the basis on the date of death. But most of the time I have clients who listen to what I'm saying. And this year I did have another client that came in, and her entire brokerage report was all for her brother's cost basis while he was alive, and none of it had been updated to his valuation on the date of death. And the brokerage house was actually apologizing for not having caught that. They were kind of embarrassed that I had to point that out, because it is something that they should know to be doing. So that's one way to look up basis, is on a place like Big Charts. And the rule is when you're looking up the basis on inherited stock, you have to go on the average of the high and the low for the day. So if we had a person who died on May 26, 2009, we would be looking at the low and the high on that day and averaging them. And the high was 1120. The low was 10.625. I'd add those two numbers together, divide them by 2, and that's the number that I use. Is it just a T for AT&T? That makes no sense to me. I could swear it was something different. It is. You're right. There's AT&T. Okay. All right, let's do another one. Now, one of the ways I like to look stock up as well, because this can be a way to establish basis in stock, certainly, but it doesn't go back in time earlier than 10 years. I'm not a subscriber paying money to Big Charts, nor will I ever be. So what happens when it's farther back in time than that? Well, one of the things Big Charts does tell me that I do like is it says no splits. So if the question was, were there any splits? The answer here is no, there weren't. But if I want to go back farther in time, let's see, if the farthest back we presumably can go is 2002, right? Because that's 10 years. Oh, that's a Sunday again, darn it. Let's go to the 24th. There we are. No splits even since then. It's been a relatively silent 10 years for AT&T. But there was a lot of action with them in the late 90s when they were spinning off Lucent Technologies. There was all kinds of stuff going on back then that we had to deal with. Now, another way I can look up AT&T, especially if I want to get into these spin-offs and mergers and so forth, is to actually just go to AT&T's website. And to do that, or for any site I might be interested in, I would just go AT&T. So this is Shareholder Services Investor Relations. And pretty much any company I've ever attempted to find stock information on, I have been able to get that just by going to the website of the company that I'm concerned with, finding the Investor Relations link, and you can see right in here we have stockholder services, including a cost basis guide. And if we go in there, it gives you all kinds of information about why keeping track of your basis is important, but it actually gets you to a calculator eventually. How to calculate cost basis worksheet. And then it says, well, what stock did you sell? Let's just go with plain AT&T. Here we are. If you owned AT&T shares before the divestiture of Southwestern Bell and other regional telephone operating companies on January 1, 1984, enter the amount you paid for your shares way back then. So anyone around who's owned stock in AT&T since before 1984? Because if you have, it's a pretty complicated formula. You start up here. The more recent you purchased your stock, the higher up or the lower down on the sheet you go, because the less there was. But each one of these is showing that there was a split or a spin-off. And if it was a spin-off, then you're worried about how much of your cost basis stayed with AT&T and how much of your cost has transferred over to that spin-off. And a merger is, of course, the opposite. All right, so that's two tools that I use. The last tool I use is to call up the broker and yell at him sometimes. No, I don't yell at him, but I sweetly say, could you please give me the cost basis in this stock? It's not on your form. And they go, gosh, you're right, it's not on that form. And they scramble around and they put it all together and they fax it or email it, which often makes me remark to myself, why don't they just do it ahead of time? Because it must absolutely drive them crazy, the number of phone calls they get in a tax season. It's like us and phone calls from mortgage lenders that they want us to write a letter that we prepared a tax return for a client who's applying for a loan, or we have to give the client a copy of the return we prepared for them because they're applying for a loan. You get like 400 of those calls a week, it seems, in the middle of the last week of tax season. So I kind of know how much that irritates me when I'm getting these calls when I'm busy, and these brokerage houses have to be getting way more of it than I do. So we talked about inherited stock already. Let's move on to stock acquired at divorce. If you acquire stock pursuant to divorce, your basis is the same as your former spouse's basis, and you should determine or use your former spouse's purchase date and purchase price to determine your basis. Now really, again, when there's a divorce situation, there should be this transfer of information, and sometimes it's not so easy to get that, especially if it was a really ugly, nasty divorce where no one's speaking to each other. It can be a challenge. It can also go quite smoothly. But I would say the most complicated one I dealt with was a woman who divorced her husband and got a bunch of Nike stock that he had received through incentive stock purchase options and ESPPs and figuring out how much had been grossed up on his W-2 and all of that. It took a lot of time. So let's take a look then at the things that can make that complicated. Employee stock options. There are three kinds of stock options: incentive stock options, or ISOs, employee stock purchase plans, or ESPPs, and non-statutory, non-qualified stock options called NQOs. Within the statutory stock option category, there are two kinds: incentive stock options and options granted under employee stock purchase plans. Statutory stock options are relatively uncommon, and the reason I say that is just been my experience. When I have clients come in, how many of them have qualified stock options? I had one this year, and that was the first one I can remember in many years. They were really big in the 90s. So an incentive stock option, what that is you work for an employer, and that employer says if you achieve a certain milestone, you're going to be able to exercise these shares. On this date in time, we're telling you that in another date and time, if you're still with us, we're going to give you the authority to exercise these. So there's a grant date. That's the date we're telling you you can make the exercise, or that these will become available to you. And then there's the actual exercise date. And when an employee reaches that point in time, they can exercise and purchase that stock at what it was worth or at a discount from what it was worth earlier in time. And those were real popular in the 90s. But there were a lot of complexities to it. The federal government didn't like it. Also, it created problems for the people who were exercising those options, because they'd exercise them, they'd get hammered with alternative minimum tax, and the stock would drop in value. They've paid tax on money they never made. It was quite a nightmare. And so they've kind of sort of gone away. They're still out there. It's still legal to do it. It's just there's not that many companies doing it. But we'll discuss some of the rules on how you deal with those. On to the statutory stock option question, and what does it mean when you have one that you have exercised? We're going to talk about that. But my main introduction and point to it is that these are quite rare. What's more common are non-qualified options. People who have the ability to purchase a stock option, but never allow it to become a qualified option that gets the special tax treatment. So it might be incorrect to say that stock options are incredibly rare, I never see them. That's actually not true. What's incredibly rare is that the people hold them long enough for them to become qualified. Few people do that. Most people purchase them and sell them instantly. So they are what we call NQOs. An incentive stock option that becomes qualified is one that has to meet holding periods, and we're going to talk about those. And those are holding periods that almost no one attains. But this year I did have a guy doing it. First one I've had. I was told I did 400 returns this season. And I do a lot of fairly high-end returns. I had no idea I did 400 in a season. That's what might be why I was so tired and cranky at the end of the tax season. And I do that many every year for 20 years. And I'm telling you, I just don't see these very often. And I live in a place where there's a lot of high-tech industries that tend to favor those. But this year I did have one, and about 15 years ago I had one like that. They're not too common. But what is common is the other kind, which is I have the stock option, I buy it, and I instantly sell it. Or within a day or two, I sell it. That happens a lot. The other thing that happens a lot is these ESPPs. And ESPPs are remarkably common. And you can be purchasing ESPPs if you're an employee at Walmart. So you don't have to be in high-tech industry. You don't have to be a high-level, high-wage employee to be taking advantage of employee stock purchase plans. I've had people who work for Walmart as checkers having these, or as people working in the storage or the back area in the warehouse having ESPPs. So these are a much broader category that affect a much wider range of income levels. Usually employee stock purchase plans have nothing to do with the direct compensation of the employee. They can, but an employee in a company can be told that they have a right to purchase a certain amount of stock at a certain price, and then that typically is a part of their compensation. But how a company arrives at that, that's a negotiation between the company, maybe the employee union. There's all kinds of reasons why a company will have them. From our perspective, none of that matters. The why and how of it doesn't matter. What matters is what we do when the person did participate in that plan and has sold the stock. Now, to qualify for special tax treatment under the rules for statutory stock option plans, both of the following must be true. You must be an employee of the company or a related company granting the option from the time the option is granted until 3 months before you exercise the option. The option must be non-transferable except at death. We're going to look first at these incentive stock options, and you're going to see why it's so hard for people to qualify. If you received a statutory stock option, you do not include the value of the option in your income when the option is granted or when you exercise it. Note, however, that the exercise of ISOs may subject you to the alternative minimum tax. What happens under AMT is if you purchase an incentive stock option and you do not turn around and sell it, and instead you decide to hold it, and you purchase that stock for less than it's worth, you've got a gain that's occurring there. And just because you've purchased it for less than it's worth, the law is saying that there's profit to you. Now, under the regular tax, you don't have to report that profit. You can just sit there. But under the alternative minimum tax, you do have to report that profit. So you would need to file Form 6251 in the year you exercise those options, and whatever that spread is or whatever that profit is on the day you buy, you have to pay tax on it, even if you've never sold and realized a penny from it. And there was quite a bit of that going on in the 90s, and people were losing their shirts. I can remember a few years ago a man came to me. He'd been a customer of ours for quite a while, and he'd started up a company, an insurance company of some kind, I think, and he was being bought out. And part of the buyout offer was to give him all of these incentive stock options, and they were worth about $2 million. And he was saying, should I take cash, because they're offering me cash, or should I take these stock options and then just sell them right away, or should I hold on to them? So I ran the numbers for him, and under alternative minimum tax, he's going to owe, well, a lot of money. $2 million times 28%, that's how much he'd be paying under AMT without having sold it. So that means he's going to have to come up with the cash from somewhere to pay that tax, and then what happens if the stock drops in value? So my recommendation to him was, well, if it's worth $2 million and you're allowed to sell it now, then I'd sell it now, because a bird in the hand is worth two in the bush, right? There's the possibility you'll get better tax treatment in the future, but that's an awful lot of money to put at risk. So what he eventually did, I don't know, but that's an example of how you can get yourself into big trouble owing tax with money you've never made. It's a really dramatic example. Now, there is a problem historically with these ISOs in that even though the law says you're supposed to report the income, there's never been a reporting function where a company that issues incentive stock options to an employee tells the IRS that that happened. So do you think that maybe people were exercising stock options and then not reporting it on 6251? There was probably quite a bit of that going on. And so in 2010, the IRS introduced a new form called 3921. And Form 3921, which is on the next page, is used to notify the IRS that an incentive stock option has been awarded. It shows the date the option was granted, the date that it was exercised, the exercise price, and the fair market value of the share on the exercise date. So in that employee should be filing a 6251, and all of the information necessary to prepare the 6251 is on this form. And then you must recognize or report gain or loss on your return for the year in which you sell. And we'll, at the end of today's class, talk about how profit on the sale of an incentive stock option will vary under AMT and under the regular tax. Because of how the tax treatment differs, you end up with something called dual basis. One basis under AMT and another basis under the regular tax. Now, you're only going to get favorable treatment even from having incentive stock options if you meet the holding periods. So let's learn what those are. To receive special treatment, you must hold your statutory stock options for the following periods of time: at least 1 year from the exercise date and at least 2 years from the grant date. If you do not meet the holding period requirements for the ISO, you may have ordinary income that gets reportable as wages. So let's go up here. We've got the date that the option is granted, the date that it's exercised. Let's suppose it was granted a year ago and I'm exercising it today. I have to go at least 1 year out before I sell to get favorable tax treatment. And if I sell within a year, I'm not going to get that favorable treatment. And the difference between the exercise price and the fair market value on the exercise date is going to have to get grossed up on my payroll. I'll have to pay payroll tax on it. And that's the way it is actually done for most people. Most people pay that payroll tax because they have non-qualified options. So here is an example, though, of a qualifying sale. Your employer granted you an incentive stock option on July 13, 2009 to buy 100 shares of Mega Corporation at $20 a share. You exercised or purchased the stock a few months later for $20 a share. At that time that you purchased it, the fair market value was $30. And then on August 23, 2011, you sold for $35 a share. So I've got a table here that kind of lines those dates up and makes it easier to see them. We've got the grant date and the grant price, the fair market value on the grant date, and the exercise date. And so we'll see that the exercise and the grant date are only a few months apart, and I cannot sell within a year of this date, and I can't sell within 2 years of that date. So I go over and I say, what date do I sell? If I sell on August 23, 2011, I'm good. I'm more than a year after this date, and I'm more than 2 years after that date. So this is a qualifying sale. It means that I'm not going to have to report any amount of profit on that sale in my wages as income. So what will happen is, for alternative minimum tax purposes, I'm going to have to increase my basis and report income at the time I exercise this stock. But under the regular tax, I do nothing on exercise. And then when I sell, I'm going to be reporting a gain as a long-term capital gain on Schedule D, and I'll have no recognition under payroll laws. Now here's an example of a disqualifying ISO sale. Your employer granted you an incentive stock option on July 13, 2009 to buy 100 shares of Mega Corporation stock at $20 a share. You exercised the stock on January 10, 2010 for $20 a share when the fair market value is $30 a share, and then on April 23 you sell at $35 a share. Well, all of the facts in this example are the same except the final fact right here, which is it sells too early. Now when we sell is more than a year after the exercise date, but it is not more than 2 years after the grant date. So my employer has to track this information and do something with it. Even though you held the stock for more than a year, you sold the stock within 2 years of receiving the stock option grant. You have to report the difference between the option price, which is $20, and the fair market value on the grant or the exercise date, $30, as wages. The rest of the increase in value is capital gain. So this is the grant price. This is the grant fair market value on the grant date. Because I don't meet the rules, the difference between these two numbers has to be added to my wages. I have to pay income tax on that. Also Social Security and Medicare tax. When I sell, I'm selling it for $35, but for cost basis purposes, my cost basis will be this $30. And how do I arrive at a cost basis of $30? Well, I take what I pay, I add the extra amount included in my wages as income, and that gives me my basis. And then I sell for $35 a share. That gives me a profit. So how much do I have as a gain? Well, the selling price is $35 a share. The original purchase price is $20 a share. giving me an overall profit of $1,500. However, because I don't meet the holding requirements, $1,000 is going to get added to my payroll as compensation, and that $1,000 adds to my cost. The original purchase price being $2,000, I'm going to add $1,000 of cost. That leaves me with a long-term capital gain of $500. So on Schedule D, I'll report a long-term capital gain of $500. And on the wage line of my tax return, my wages should have been bumped up by $1,000. Employee Stock Option and Stock Purchase Plan, or ESPP. We see these a lot these days. As I said at the start of this particular discussion, these are one of the most common things I see, and they're one of the messiest things I see. Depending on the company that an employee works for and the astuteness level of the employee working in that company, I may get everything I need to figure an accurate tax return, or I may get nothing at all and only be working off my understanding of the topic to even arrive at a good number. As we go through it, I'll show you and explain a few of the things that I run across with this. Employees who exercise stock option rights or participate in ESPPs are usually very confused and do not know how to report income from the sale of their stock or how to calculate their cost basis. And how you calculate the basis in an ESPP depends on the kind of employee you are and the type of plan that your company has, none of which, from the tax preparer level, is a decision that we make. We simply need to know what that company is doing by asking some questions. Now, because so many tax returns are filed with basis reporting errors for ESPP shares, the IRS has introduced Form 3922, beginning with tax year 2010. And the intent of this particular form is to provide the employee with a record of their basis in the ESPP shares that they are purchasing. So let's take a look at this one. It's fairly similar to the 3921 we saw earlier. We first have the option grant date. We have the option exercise date. We have the fair market value per share on the grant date and the fair market value per share on the exercise date. We also have the exercise price paid per share. It's got a little bit of extra information here. Corporations are required to file this form and furnish statements to recipients containing information that is furnished to the IRS, and in some cases also additional information. Now, I would say one of the best companies I have to work with on these ESPPs and NQOs, usually, non-qualified options, that I see a lot of in the city of Portland is Intel. They're a high-tech company. They've got a lot of high-paid employees who get all kinds of ISOs, RSUs, ESPPs. So I'm seeing them all the time. And some of the illustrations that I'm going to be showing you in today's class come from actual statements I've seen from clients who work for this company. Another company locally that does work with ESPPs and NQOs is Nike. Nike's another big company that most of you have heard of, and they're not very good at it. The documentation that they give their people or that their people seem to have access to easily is terrible. So it depends on, you know, what company your customer is coming from as to how good the information you get is. Now, interestingly, this year Intel had a real mess up, and all of the information that was being reported on the sale of ESPPs was wrong. I saw brokerage statement after brokerage statement after brokerage statement with the wrong basis reporting. But theoretically, this Form 3922 should be able to reveal to you what an employee's basis is in their ESPPs. And their basis is typically going to be the difference between the fair market value of the share that they bought and what they actually paid for it when they bought it. And here's why. We're going to take a look at all of the reasons why this basis is the fair market value of the stock. So even though a person might buy stock for less than it's worth, their basis is usually going to be what it was worth. So how do you get a basis that's higher than what you have to pay for it? Well, it's because an employer has to treat compensation that they give to an employee as wage. And it doesn't matter what form the compensation takes, they're required to report it as a wage and put it on the W-2. So when an employee is allowed to purchase stock for less than it's trading for because they're an employee, that's a form of compensation. And that compensation has to be added into their W-2. So any amount that's added to the W-2 increases basis. So when I'm looking at this particular form, and I have to say that actually my clients do come in with forms that look like this, So many of the brokerage statements we get have substitute forms that look nothing like the IRS has as a baseline or that I would show you. But when my clients come in with a 3922, it does look like this. And what I'm interested in when I'm looking at it is, okay, this is the fair market value per share on the grant date. And then I look at the fair market or the exercise price paid per share and the fair market value on the exercise date. I'm typically going to look at the fair market value on the exercise date, and that's usually going to be their cost basis. Not always, but almost always. And it doesn't matter that they bought it for less than that the exercise price down here is less. Their cost is usually going to be the fair market value, because the difference between this number and this number is going to get added to their wages. Now, I can make that assumption, but is it enough to assume that they actually did get grossed up on their W-2? The employer is required to gross them up, but their basis will only go up if the employer did in fact gross them up on their payroll. And how do I establish that the employer did that? Well, the only way we can do that is to see if that employee was given a notice of exercise or an advice of exercise by the employer. And that advice of exercise, if it came from Intel, beautifully shows the date that it was exercised, the amount that was added to payroll, the taxes that were withheld. It shows all of that beautifully if it's Intel. If it's another company, it may or may not be able to get that information to me. So then the next thing I might look for is an actual pay stub to see if the pay stub is showing a gross up that occurred in that pay period. Now, what I inevitably find is that if I assume there was a gross up and I go through all of the legwork to prove that there was a gross up, I'm almost 100% accurate that what I'm looking for can be found if I'm willing to look hard enough. But it can only be done if my client is willing to cooperate with me by going and finding back payroll records. And usually we're looking in the last year, but if they exercised that stock 3 years ago, that's getting harder. The other thing I like about these 3922s is they get filed with the IRS, and that means even if your client lost them and has no other record, as we go forward in time, we can actually go as tax preparers on behalf of our clients, of course with their written authorization, and get copies of these. So I can see a future, say 2015, where I have a client who exercised a stock option in 2011, and I'm going to be able to ask IRS for a transcript that will show the 3921 or the 3922 that was filed at that time. So how does it work when we sell those ESPPs? Well, first thing I wanted to talk about again was how this employee compensation thing goes on. If you participated in an employee stock purchase plan, you do not include any amount in your gross income when you receive a grant or exercise an option to purchase stock. When you sell the stock that you purchased by exercising an option, you may have to report wage compensation and capital gain or loss at that time. Your holding period for ESPP stock begins on the day after you exercise the option, and for more information on the tax treatment and holding period requirements for those shares, you can go to IRS Publication 525, Taxable and Non-Taxable Income. Reporting the sale of ESPPs. If the special holding period requirements described below are met, the sale of stock is treated generally as a capital gain or loss. However, you may have compensation wage income if the option price of the stock was below the stock's fair market value at the time the option was granted, or you did not meet both of the holding period requirements. Well, one of the whole points of ESPPs is you're getting them for less than fair market value. So as soon as you see ESPP, and the ESPP is, of course, for their company that they're employed by, you can assume that they probably bought it at a discount. And that rate of discount is usually 15%. So if it's trading on the stock market for $10, odds are my client employee probably bought it for $8.50. And the difference, the spread between $8.50 and $10, is that discount, and that discount is supposed to be wage income to them. Now, to meet the holding period requirements for ESPPs, you have to hold the stock for 2 years from the time the option is granted to you and more than 1 year from when the stock was transferred to you. If you do not meet both of these holding period requirements, there is a disqualifying disposition of the stock. And we go through a variety of different options of how that stock is going to be treated based on how you hold it. If the holding period requirements are not met, then your employer should report compensation income in box 1 of your W-2 in the year of the disqualifying disposition. the amount to be reported as compensation income is the excess of the fair market value of the stock on the date the stock was transferred to you over the amount that you paid for the stock. Hearing me speak these words is difficult to comprehend, so I'm going to show you some illustrations, but I'm just explaining the rules first, and then we'll see how these words translate to actual events. And the events I'm going to show you are real ones. Like my client came in, and these are all the numbers that were really on their documents, and I turned them into a problem so that we were actually dealing with a real one. Now, if the holding period requirements are met and the option exercise price is below the fair market value of the stock at the time the option was granted, you report the discount as compensation income when you sell the stock. Generally, the compensation income is the lesser of the excess of the fair market value of the stock on the date of disposition over the exercise price, or the excess of the fair market value of the stock at the time the option was granted over the exercise price. So it could be that you're granted the option at a particular price, and then time passes and the value goes up. So you exercise, and you're able to exercise at this lower price. So the spread is quite high. And then you sell. And when you sell, are you selling up here, or are you selling down here? Or are you selling here? And which of these two prices, the grant price or the fair market value on the grant date or the fair market value on the exercise date, which of those you use is just going to depend on your holding period and what you sell it for. And obviously, they're going to be working to only make you pay tax if you sell for more than one or both of those numbers. And if you sell for more than the lower number, you're going to go with the lower number. But if you sell for more than the lower number but less than the higher number, you're still going to go with the lower number. So if it's worth more on the exercise date than it was on the grant date, but then you sell it for less than the exercise price, but more than the grant price, they're not going to, you're not going to have to pay wage income on that. That's the bottom line. So if the holding period requirements are met and your gain is more than the amount you reported as compensation income, the remainder is capital gain reported on Form 1040 and on Schedule D and on Form 8849. But if you sell the stock for less than the amount paid, you actually have a capital loss and you do not have ordinary income reported as wages. So we're going to, as I said, in a few minutes, look at to see how all that works. Calculating basis in your ESPP shares. First, you look at the option. For an ESPP option granted at a discount, your basis is the amount you pay plus the amount you must include in your wages as income. This amount includes the lesser of the discount based on the beginning of the offering period or the profit when you sell. Here's an example. Your employer granted you an option under its ESPP on April 19, 2009 to buy 100 shares of Mega Corporation stock at $20 a share. And at that time, Mega was worth $22 a share. So you have a spread here of $2. You're granted at 20 and it's worth 22. You exercise or purchase the stock on October 10 for $20 a share, and at that time the fair market value is 23. Then on December 23, you sell for 30. Because you held the stock for more than 1 year and you sold the stock at least 2 years after receiving the ESPP stock option grant, you have a qualifying sale. You must report the difference between the option price of 20 and the fair market value on the option date or grant date of 22 as wage income on your W-2. And it's actually your employer who's responsible for doing that. They're supposed to track all of this and do it. So you can imagine it's a very complicated payroll nightmare, I think. And then the rest of the gain is a capital gain. So your capital gain is the difference between 22 and 30. And let's just suppose we've got 100 shares. The selling price on those 100 shares is $30. So we have a selling price of $3,000. The amount I pay is $2,000 and the gain is $1,000. And of that gain, $200 is going to get bumped up on my W-2, and $800 is going to get reported as a capital gain on my Schedule D. How do I figure all of this out? Well, one of those is to go back up to that 3922 document because it's showing the date the option was exercised, the fair market value on that grant date, the fair market value on the exercise date. And if I meet the holding periods, I should be able to go the difference between the grant price and my fair market value on the grant date. But if I don't meet the holding period, then I have to go with the difference between the fair market value on the exercise date and the grant price. If I meet the holding periods, I get a little bit better tax treatment, but you can see it's not perfection of tax treatment as we have in ISOs, because with ISOs, we'd have no wage income at all. But with ESPPs, there's always a certain amount of wage income. It's just is the difference for the wage income going to be the difference between the grant price and the fair market value on the grant date, or is it going to be the grant price and the fair market value on the exercise date? And if I meet the holding period requirements, it's going to be the smaller number, and if I don't meet them, it's going to be the bigger number. So you want to see one with a bigger number? Here's an example of a disqualifying ESPP. Your employer granted you an option under its ESPP on April 19, 2009 to buy 100 shares of Mega Corporation stock at 20 a share. Mega Corporation was selling for 22 at that time. You exercised on October 10 for 20 when the fair market value was 23. So all of the facts are the same as in the earlier example, except bungo, we sell too early. You sell the stock on April 23, 2011 for $30 a share. So April 23 of 11 is less than a year after the exercise date, but it is more than 2 years after the grant date. We flunked one of those two tests, and so we're going to have to go with this as our valuation for determining how much has to get added to our wages. So we're going to take $23 minus 20. That's $3 per share is going to have to get added into payroll as wages. That makes the cost basis $23 per share. Under the earlier example, when we went with the fair market value on the grant date, the cost ended up being $22 per share. And that's affecting what we enter on the Schedule D. So in this illustration, our cost is going to be $23 per share because $3 a share has to get added to our wages. So the selling price is $30, giving us $3,000, and the purchase price is still $2,000. The gain is still $1,000, but how it's reported is different. $300 is going to get added to my payroll. $700 is going to be reported as a capital gain, and that means my cost basis is, of course, $2,300. So let's move back to compensation rules relating to ESPPs. And what I did to try and maybe bring some clarity to this, because the way I started to really learn about how all these ESPPs worked was actually in QuickFinder. If any of you have read QuickFinder, it does a nice little summary of ESPPs and explains them. But I thought, okay, where are they getting that from? Is it in any publication anywhere? And the answer is yes. It's in Publication 15B, Employer's Tax Guide to Fringe Benefits. So all of the rules about gross up on W-2s and why they have to happen is really falling under payroll rules. So as tax preparers, to understand how the basis in ISOs and ESPPs is calculated, we have to have a little bit of an understanding about how compensation works for payroll purposes. And Publication 15B instructs employers to include as income in Box 1 of Form W-2 the discount given to an employee on stock acquired by the employee through an employee stock purchase plan when the stock is sold or disposed of, and the spread, or the difference between the exercise price and the fair market value of the stock at the time of the exercise, given in a disqualifying sale or disposition of stock acquired by an employee through the exercise of an incentive stock option or an employee stock purchase option plan. So let's go through and take a look at those again and how they are treated for the employee on the employee's W-2. Because there's two different types of exercises going on, and how IRS wants them to be reported is actually completely different. The first one is with NQOs. And an NQO is an incentive stock option that is not held for the minimum holding time. When it's not held for the minimum holding time, and this is usually the case, there is a reporting that is supposed to happen on the W-2. The difference between the fair market value of the stock on the exercise date and the exercise price has to be added to that employee's W-2 as income. And that difference that is added to the income is indicated on the W-2 with a code V in box 12. So if you have a client who has a W-2 with a code V in box 12, that tells you they exercise stock options during the year. That's what it means. And it's telling you how much profit was added to their pay because of that exercise. IRS is saying that whatever that extra pay is because of the exercise, it's taxable as wages in box 1, and it is also subject to Social Security and Medicare tax, so those boxes will be bumped up as well. But when you exercise ESPPs, oddly enough, they are treated differently. In their case, only the wage box is increased, the difference between the fair market value or the exercise price and the grant price is only subject to income tax and not subject to those payroll taxes. So to make sense of a W-2 that has ESPPs on it, it takes a little bit more work than to make sense of a W-2 that has stock options on it, because the stock options have to have that code V. So to show you how all of this works, I've created a comprehensive illustration, and this is based on a real-life client that I had. Every single number on here is a real number that appeared on his advice of exercise notices, on his W-2, and on his payroll stubs. So I've just made, of course, him anonymous, and you don't know who he was or what company he worked for, but we're going to see how all of his numbers matched up. And when you're a tax preparer and you're able to balance all of these numbers in all of the ways you expect, then you know you've got it, and you can put a number on the tax return that you can back up and verify. So let's do this for our tech employee. On February 19, he bought and sold 199 shares through his ESPP at $21.263 per share, or a total of $4,231. Then the fair market value on those shares on that date was actually $6,000. So this is the spread right here. There's also a spread per share here. $21 a share is what he paid when it was worth $30, and the net price that he paid was $4,200 when it was worth $6,000. So we have a spread there that we know needs to get included in his income as wage. Then on August 19, he bought and sold another 82 shares through his ESPP at $18 per share, or a total cost of $1,533. The fair market value on that same date was $22 per share, or $1,800. So we're going to calculate his basis in his ESPPs as follows. We look at the number of shares, the amount paid for the shares, and the fair market value of the shares on the date of purchase. And we'll see that the difference is $1,833 for the first 199 shares and $270 for the second 82 shares. If we add those two amounts together, we get $2,103.79, and that is the amount that tech company must include as income in box 1 of his W-2. So I, as the tax preparer, I'm looking for that $2,100 somewhere. And it's actually broken up into two different dates. I won't find $2,100 on a single pay stub. Maybe the year-end pay stub will show a total for the year. But ideally, I might need to actually look for two pay stubs, one received sometime after February 19 and one received sometime after June 7, where I'm actually looking for this number and this number to appear. Actually, it's supposed to be August 19. I don't know where June 7 came from. There's too many dates on here. Obviously, I've got a few things in my manual I need to fix. I stare at it till I'm blue in the face, but it's hard to get those things. Okay, tax cost basis in the stock is calculated as follows. The number of shares is 199 and 82. The amount paid for the shares are these lower numbers, lower than the fair market value. And because it's less than the fair market value, we have to add it to his payroll. And as soon as we add it to his payroll, his cost is the fair market value, which is what I always come back to. Cost on ESPPs and NQOs is nearly always the fair market value on the exercise date, almost always. The only time it's not is when they meet the holding periods, and almost no one bothers meeting for those holding periods. There are people who do. There are people, who have the financial resource, and they are not treating these incentive stock options as bonuses and cashing them out and taking the money and spending it, but rather they're keeping the stock, holding it, and allowing it to grow in their portfolios. There are people who do that, but the vast majority look at it as a payroll bonus. They cash them out and take the money. And that makes it simple for us. What was it selling for on the date that they exercised, and what did they exercise for? And that difference is going to add to their basis, and so their basis is what it was trading for on the date they exercised, nearly always. Then on March 3, Tech exercised an option to buy and sell 999 ISO shares. So the first two purchases were ESPPs. Now we're moving on to ISOs. 359 shares at $20 per share, totaling $72.63, and 640 shares at $19 per share, totaling $12,160. So the total cost of 999 shares is $19,422. The fair market value of those shares was actually $30, or $29,000. So that's a big difference. That's a big break. And I do usually see that. Incentive stock options usually have a much bigger spread than ESPPs, because ESPPs are usually a 15% discount. But ISOs can be hugely bigger profits. On June 7, Teck exercised an option to buy and sell 1,275 ISO shares as follows. 262 shares at $18.63 per share, or $4,881, and then another 1,013 shares at $20 per share for a cost of $21,000. But at that time, so he gets a total cost in those 1,275 shares of $25,000. But the fair market value is actually $36,337. So we've got a profit here as well. And he has to include those profits, or his employer needs to gross up his payroll by those profits, because he buys and sells in the same day. And that's totally normal. Since both these option sales are non-qualifying dispositions, or NQOs, you calculate Teck's basis as follows. We go with the number of shares, the amount paid for the shares, the fair market value, and calculate the difference. $10,500 profit on the 999 shares, and a $10,400 profit on the 1,275 shares. The total of those two numbers is $20,991.92, and that has to be added to his income as wage income. The employer has to include that as wage income in boxes 1, 3, and 5 on his W-2, and we should be looking on that W-2 in box 12 for a code V with $20,991 next to it. So let's look at his W-2. We have a total of 999 shares of ISOs and 1,275 shares of ISOs. And his cost basis is going to be the amount he paid plus the amount grossed up on his payroll. So this is his cost in those ISOs. $29,900 for the first 999 and $36,000 for the second 1,275. So that's his cost. That's relevant for us preparing his Schedule D and his 8849. The W-2 is a separate issue. So on the W-2, our Teck employee has received a W-2 showing $70,000 of wage income, and there's that code V in box 12 showing $20,992. Now, how do we know that the ESPP shares of $2,000 profit are in that box 7? How do we know that? We know that the ISO is because there's a code V right here. But how do we know or decipher that the ESPP gain has been included in this box? I know that it's supposed to be, but was it? There is a possibility the employer payroll department could mess that up, right? So if I say that the basis was increased when it wasn't, that would be a problem. And if I assume that it's in the W-2 and it's not, somewhere there's a problem. So I like to make sure everything balances out. And is there a way for me to put the puzzle together and figure it out? Well, there is, if I have all of the facts and I think through it a little, and I actually do. Firstly, I start with box 3 because I know that box 3 would not include the ESPP profit because it's not subject to that Social Security tax. And I know that this $20,000 is included in box 3 and it's also included in box 1. And I know that this number here is a 401k contribution, and it's going to be subtracted from box 1, but it's not going to be subtracted from box 3. So if I have all of those 3 pieces of information, I actually can figure it out. It's there. I look firstly at the box 3 wages that are $76,000, and I know those don't include the ESPP profit. I subtract out the 401k, and I get $68,324. Then I add in the $2,103 from the ESPP, and I have a match to box 1, just like that. Then I look at this code V, and the difference between the option price and the fair market value is included in income as wages paid. So I take the 2 amounts that I showed earlier up here, 10.5 and 10.4, and those equal the 20 that I want to see there. Okay, comprehensive illustration, part 2. So we've just gone through and talked about all of the transactions that occurred. There were 2 separate ESPP purchases and sales, and there were 2 separate NQO purchases and sales. And because they were sold, they're going to be reported on a 1099-B, aren't they? Now, earlier in class, I showed you the government's standardized format for 1099-B, but do we ever have a client come in with a 1099-B that looks like that? Absolutely never. In fact, every 1099-B we see varies according to the brokerage house that issues it. There is no standardized substitute format. So our job as tax preparers is to learn what the information used in the substitute format means. And box 1A is the date of sale, and box 1B is the date of acquisition. 1B is a new box. It never had to be there before, because now we have cost basis reporting going on with IRS, and so these acquisition dates are supposed to be in there. Then we have the share quantities exchanged, and we have the description. And all of these lines are matching up with the boxes on the 1099-B. So if the 1099-B says that the description should be in box 9, then the substitute 1099-B should say that this was the amount that would have been in line 9 if we'd given you that box. And then we have the sales proceeds less commissions, line 2. And these are the amounts that all of those shares were sold for. And we get $73,953.11. And if you compare that to the cost, each of these cost items is a perfect match to the numbers we had up in here. So we're looking at these cost amounts up here. So each of those should be a perfect match. Now, the piece of information I gave you at the start of today's class was that the company I've always considered to be the best at these reporting issues is Intel, and this year they royally blew it. Every single brokerage count statement I got for an Intel employee had the wrong basis. The basis that was being reported by, I think it was USB, who was handling, or is it UBS? Yeah, UBS. UBS was handling all of these brokerage statements, at least in the state of Oregon, for Intel. And what they were doing is they were reporting the exercise price rather than the fair market value. So they were showing gains that never occurred, because I know that the fair market value spread between the fair market value and the exercise price should be included in the wages, and the IRS was being given information by UBS that showed only the exercise price and not the higher fair market value price. So I knew that there was a problem, and it was repeated for every single Intel client we had. And every Intel client that was able to go back and talk and figure it out found out, yes, it was wrong. So even though basis is being reported on the 1099-B, you should not assume that it is correct. So, and the reason I knew that there was a problem was it was showing a profit. And when people exercise in NQOs and ESPPs in disqualifying dispositions, they will nearly always realize a loss. It's almost impossible to have a profit. So if you're seeing a profit, it tells you there's probably a problem. So here we have cost. On this particular 1099-B, though, is perfect. I'm showing you one where it is correct. So the cost, you will see, on this 1099-B is greater than the sales price. The reason for that is that the sales price is less commissions. And usually there is a commission fee of somewhere between $20, $25 per sale, sometimes up to $50. So I'm looking to see $25 to $50 loss. Another reason why you could have a loss, or it is possible sometimes to have a gain, is if you're dealing in a large enough number of transactions. I once had a man with a company who was able to exercise literally 100,000 option shares in a single day. It was a huge amount of money, you know, over $1 million of shares he was exercising in that day. And it takes a certain amount of time to exercise and then dispose of those. And during the period of time he had them, even though it was less than a day, there was a fluctuation in the market. So he actually realized a profit in that day. It is possible, but most people are dealing in smaller transactions that are disposed of almost immediately, and we're not seeing a gain. So here we have a Schedule D, and of course, beginning in 2011, we have this 8849. And the deal with the 8849 is that this is where we are now reporting each sale. So here we see each of these transactions, 199 shares, 999, 1275, 82, the acquisition date, the sales price, the acquisition price, and annoyingly and irritatingly, they don't show the gain or loss on each one. They only show the total gross cost, or total gross proceeds and the total gross cost. And then these two totals from line 2 carry up to the Schedule D, and we enter total sales amount and total cost. And ultimately, as tax preparers, we never want this sales amount on Schedule D to be less than the sales amount on the schedule or on the brokerage statement. The IRS is going to be matching this number to this number, and if this number is higher, they're okay with that. Actually, if the number on the Schedule D is higher than this number, they're okay with that. But if the number on the brokerage statement is higher than the amount reported on the tax return, they're, of course, going to be looking for why you underreported. Now, this number in column F, which is the cost basis, can certainly differ. Because if the cost basis reported on the brokerage statement is wrong, then there will be a difference, but we have to explain the difference in this middle column. And how you go about doing all of that, that's going to be our subject of one of our classes next Tuesday when we get into sale of assets. We show how to do all of that. But for today, we're just worried about getting cost basis figured. This is the cost basis. This is the sales proceeds, and it is normal on sale of ISOs and ESPPs to have a small loss. Now let's talk about the idea of the cashless transaction, because most ESPPs and ISOs are sold in cashless transaction. The employee doesn't write a check to the employer for the stock and then have the employer cash the check and then issue the stock and then the employee turn around and sell the stock. That's just not what happens. What happens is the employee says to the employer, I'm ready to exercise. The employer does it all for them or tells the brokerage house to do it all for them. The gross up happens on their W-2, and they might receive a net paycheck that's higher. It's all done through payroll, and they get a paycheck for what's left after all the taxes have been held out. So employees who exercise and sell stock options in a cashless transaction do not have to report the sale of options on Schedule D and Form 8849 when their employers properly report the income on the W-2. So that code V on the W-2 tells you that a stock option happened or that there was an exercise of qualified or non-qualified options. When that happens, the employer is required to put that code V there, and if the code V is there, the employee technically is not required to report the sale. However, up on this earlier page, I just finished telling you you can never have a number in this box that's less than the amount reported to IRS. So what I see happen is that although the brokerage house is not required to report the sale, it usually does it anyway. So a code V tells me I should be looking for a 1099-B. If there is a 1099-B that reflects that sale, I have to put it on a Schedule D. Sometimes there is no 1099-B because the employer technically is not required to issue one. I say, oh, you work for your employer. I see you exercise stock options during the year. Have you been issued a 1099-B? What's that? Well, that's a brokerage statement that's typically issued to tell the IRS that you exercised and how much you sold for. I don't know anything about it. They didn't give me anything. That's usually what I hear. Well, if they did give them one, then they need to get a copy. Quite often this stuff is online. They're able to log into an account and find it if they're savvy enough to figure it out. Other times I'll ask them to go to their supervisor or their payroll department to find it. Sometimes after sending my client on a goose chase for 3 weeks, they come back and say there's nothing. And I say, well, if there's nothing, we've got two choices. One is we'll file the tax return without a Schedule D and say there was nothing. But if there was something that we haven't been able to find, the IRS is going to let you know you will receive a letter in the next couple of years, and we'll have to deal with it at that time. If there really was nothing, we don't need to file the Schedule D, and we're fine. But if there was something and we couldn't find it because you're not able to figure it out, and we don't do it, you're going to get this letter. So we could do it anyway because there's no harm in that. There's absolutely no harm in reporting a transaction and all of the information associated with that transaction just in case the 1099-B is lingering out there. So the lack of consistency creates a problem for us as tax preparers. All right, now here's the final part of this illustration. We're going to take a look at tech employees' year-end payroll pay stub. Let's see how tech employee was paid. Well, he had a base salary of $53,000. He had vacation pay. He had sick pay. Ooh, what's this? RSU? He had ESPP. He had NQO. His total pay was $78,224. Well, that's not the number on his W-2, is it? Because wait, he had a 401k contribution. So his box 1 wages on his W-2 is going to be $78,000 minus that 401k contribution, which leaves us the $70,000. And then we have this box 3 wages, which is a higher number again. It's that $78,000 minus the $2,103 up here. That's the ESPP. So in a perfect balanced world, The W-2 is going to match the payroll summary, which is going to match the advice of exercise statements that my client received from their employer at the time they exercised. We should be able to follow all of that through. Okay, the next item we're going to talk about is something called a restricted stock award. This is kind of a funny animal. I've had maybe 1 or 2 clients that have got these. And what a restricted stock award is the company says, hey, employee, we're going to give you stock. But if you leave the company, you have to return it to us. So you don't have outright ownership of it because you can't take it with you when you leave. Or typically that's what it is about. Now, it may come to a point where you actually do get vested in it, you're allowed to keep it. But with restricted stock, there's always this possibility that it could be taken away from you. And at the time that it is awarded to you, you have to gross up your payroll for the value of that stock. So you gross up for the value of the stock, but you're not allowed to cash it in, you're not allowed to take it with you, but you are allowed to receive dividend distributions from it. So understandably, that's not the favorite animal for most people, but it is out there and it can be used for that. So what happens is if you get these RSAs at the time that they are awarded, you're going to have to pay tax on that vesting. And the vesting tax is going to be the fair market value of that stock thrown into your payroll and factoring for all of the income tax, Social Security tax that you owe on it, and that has to come out and get paid somehow. And one of the ways to do that would be to just hold the taxes from any other pay they're giving you, or for you to come up with it out of your pocket and pay it. So needless to say, most people don't like that idea. The employers can find it as a way to control their stock, and in small companies that might be something that they prefer to do. But the bigger one, the more common one, and the super popular one in today's modern times is the RSUs. I've been saying that the NQOs, those incentive stock options, are kind of fading away from favor. There's a variety of reasons for it, many of which are not even clear to me. I just know that over time they're fading out. And they're being replaced with RSUs. RSUs are the new modern thing. And from a tax preparer perspective, they're a lot easier to deal with. RSUs are so simple, I can't believe it. There's nothing complicated about an RSU at all, because there's no special tax treatment that's ever given to it in the first place. It simply is treated as a form of payroll. At the time the stock is awarded, you have to pay taxes, and you're done. And your cost in that stock is whatever the fair market value was, because that was the amount that had to get grossed up on your W-2. So let's take a look at that in writing. Restricted stock units are a form of compensation used by companies to reward employees who provide certain services or reach certain milestones. RSUs have increased in popularity in recent years as many companies move away from stock options in favor of them. An employee who is awarded an RSU obtains a right to receive shares of stock when the RSUs become vested. Upon vesting, the company issues the shares and the recipient then becomes a shareholder. RSUs are different than RSAs because the employee does not receive ownership of the stock until it is vested. Most large companies like RSU programs because they are easier to administer and ensure that employees are only entitled to dividends and voting rights on vested shares. If you receive stock or other property that has certain restrictions that affect its value, you do not include the value of the property in your income until it has become substantially vested. So what that's saying is if you are being told that we're going to award you some RSUs a year from now, and at the time that they are awarded to you, you're going to have to come up with the money to pay the tax on them. Now, how are you going to come up with the money? Well, there's 2 ways that you do that. One is you sell some of the shares you've been awarded and use the money from that sale to pay the tax on the entire award. The other is to just come up with the money. So we'll show you a couple of illustrations on that. But either way, the stock is being given to you, and the fair market value of that stock when it's given to you has to be included in your pay. But what they do with RSUs and what makes it attractive to the employer is the employer says, hey, if you meet this milestone of working for us for 3 years, on the date that you reach your 3-year anniversary, you're going to become vested in this stock. And that stock has value. Now today when we're making that promise, the stock is worth XYZ dollars. Who knows what it's going to be worth in a few years, but regardless of what it's worth in a few years, it's going to be worth more than 0 unless we're out of business, right? So the employee is waiting for that magic point in time where that stock becomes vested. And at the time it becomes vested, it's simply a gross up on their W-2 or on their payroll at that time. Taxes are held out and they get essentially stock. that they now own. So it's not like they got cash because they have the stock. Now they could, if they choose, tell their employer to just sell it right away, in which case they've sold it and they have ordinary income on their W-2, but they also have a cost basis in that stock equal to the ordinary income on their W-2. So on the Schedule D, we'll report zero gain or loss, usually a small loss because of the brokerage account fees. So until an RSU becomes substantially vested, it is not owned by you and continues to be the property of your employer. When the property becomes substantially vested, you must include its fair market value minus any amount you paid for it in your income for that year. But what I see with most RSUs is the employee pays nothing for them outright. The employer is giving them the entire award. So it's not even being sold at a discount. It's just being given to them. And you know what payroll laws have to say when your employer gives you something in lieu of compensation? It is compensation. So what happens to RSUs once they're vested? Well, once RSUs vest, an employee's rights to the vested stock units become non-forfeitable. At vesting, the employee will receive actual payment according to distribution schedule. That means the employee gets dividends when they're being paid out, like any other shareholder would. And they own stock, and like any other shareholder, they can sell it. That's what it means. But what about the tax payments that are due at vesting? Once RSUs have vested, an employee may be required to pay statutory minimum taxes. If distribution of the shares is deferred, an employee may defer some of the statutory taxes until the distribution occurs. So how do you pay the taxes on the units that have been awarded? Well, depending on the plan rules for each company, there are usually two options that can be used to pay taxes at the time the shares are vested. And I've already described those. The first one is that the employee who elects net shares, and we call this first option net shares, will sell enough shares to the employer or have the employer withhold enough shares to pay the tax withholding obligations. And then the employee retains the number of shares vested less the number of shares withheld for tax purposes. The second option is to pay cash. An employee who elects to pay cash to satisfy those withholdings must provide the cash to the employer on the day of vesting, and then that money is used by the employer to pay the required payroll and withholding taxes. So here's an example, net shares. Ralph had 100 RSUs vested to him by his employer on April 1st. The market price of the stock on that day was $60, and his combined income tax and payroll tax withholding rate was 40%. Ralph's employer will include the following income on his W-2. 100 shares awarded at $60 per share. That's a $6,000 gross up that needs to happen on the W-2. Ralph's employer sells 40 of the shares to pay the withholding tax that Ralph owes. So that's 40 shares times $60 or $2,400 because the rate of tax is 40%. Ralph will receive a year-end W-2 which includes the following. Box 1 wages will be increased by the $6,000 and the withholding taxes will be increased by $24,000. Ralph now owns the remaining 60 shares and his cost basis in the remaining 60 shares is $60 per share. So his grossed up by $6,000, $2,400 of shares were not given to him because they were used to pay his tax. So the left shares that he has, what he has left over, is 60 shares at $60 per share. Example number 2 is the pay cash method. Sydney had 100 RSUs vested to her by her employer on June 1. The market price of the stock on that day was $40, and the combined payroll and income tax withholding rate is 40%. The total amount at vesting is $4,000, 100 times 40 share, or $40 per share. So total withholding tax owed is 40% of $4,000. That's $1,600. Sydney decides she can come up with that cash. She wants to keep the 100 shares, so she brings $1,600 to her employer, and her employer actually sends that to pay payroll taxes and withholding taxes, and that'll be reflected on her W-2. Sydney's employer will transfer all 100 shares to Sydney and issue a year-end W-2 which shows Box 1 wages increased by $4,000, withholdings are increased by $1,600, but she now owns all 100 shares and her basis in those shares is $40 per share, or $4,000. So in both situations, the cost basis per share is the fair market value that had to get grossed up on the wage. How many shares they're left holding at the end would depend on if they sold some of the shares to pay the taxes owed or whether they brought money to the table to pay the taxes owed. But either way, they're going to be grossed up by the full fair market value of all of the shares granted. Now what I see with RSUs RSUs seem to be the ones that they hold on to and don't sell right away. So because they were granted a certain number of shares and they had to sell a certain number of shares, what's left is theirs, and the only way they get money out of them is to actually sell them on the stock market. If they're not in a hurry to do that, then they don't, and they hold them, and they can hold them long term. So what happens to RSUs when they are sold? Once they are fully vested, the holding period and capital gain rules for RSUs are the same as for any other kind of stock. Short-term and long-term capital gain rules apply, and they depend on whether you held the stock long-term or short-term. Would there be a situation where a company gives you stock, such as a bonus, and your cost is zero? I can't think of any legal situation, because you're getting into payroll laws, and can an employer give an employee something of value and not treat it as wage compensation? The answer is typically no. Now, I, as an employer, might buy a Christmas present for my employee with money from my own pocket, and it doesn't run through the company. It's not a company expense. It's a gift from me personally and not from my company to my employees, so it doesn't appear anywhere on their payroll. But if I were to have the company purchase a gift for them and give it to them, then the company should be grossing that up on their payroll. So if I give them a Christmas bonus, things along those lines, those have to be included in wages. So I can't think of a reason why there should not be a gross up, because there always should be legally. All right, I promised we would talk a little bit about dual basis in assets. And it has to do with alternative minimum tax. And the reason we deal with dual basis under the alternative minimum tax is that when you exercise a qualifying incentive stock option, you exercise it and you hold it for more than a year after the exercise date and more than 2 years after the grant date, your alternative minimum tax basis will be different than your regular tax basis, because that spread or difference between the fair market value on the grant date and the fair market value, or the fair market value on the exercise date and what you pay for it, is wage income to you, only if you hold it short term. But if you hold it long term, it's not included as wage income, so your basis is just going to be what you paid. So we're looking at dual basis in ISOs only when they're qualifying. When they're non-qualifying, we don't have dual basis. Depreciation deductions under AMT can be different than they are under the regular tax. They're less different today than they used to be, because under AMT rules in the past, you weren't allowed to claim a Section 179 deduction, for example, that you are right now. But under AMT, you're not allowed to claim accelerated depreciation. So under AMT, you're going to be claiming straight line depreciation in most cases, where under the regular tax, you'd be claiming double declining balance. And that creates two bases on assets used in a business. And here's an example. Billy has been depreciating a computer network, and he paid $20,000 for the network. Under the regular tax, he's claimed depreciation deductions totaling $12,000, which gives him an adjusted basis of $8,000. Simultaneously, during that same time frame, his AMT depreciation deductions have only been $11,000. So his basis under AMT is $9,000. So that's one way you have dual basis, but the other way is under incentive stock options. Frankly, the depreciation difference is more common. Incentive stock options, let's look at an example there. During the year, Billy exercised ISOs in Jack Inc. At the time of the exercise, Jack Inc. stock was trading at $80 per share, but Billy exercised an incentive stock option to purchase 500 shares at only $30 per share. So there's a $50 spread there. Under the alternative minimum tax rules, that spread of $50 has to get added to 6251 as income, and Billy's responsible for paying tax on it. How much is that spread? It's $50 times 500 shares, or $25,000 that he has to add to 6251. That's a pretty big number. And after he does that, his cost basis in Jack Inc. is $30 per share under the regular tax and $80 a share under the alternative minimum tax. What happens when you sell a dual basis asset? Well, here's an example. In the preceding example, Billy held 500 shares of ISO stock with a basis of $30 per share under the regular tax and $80 per share under alternative minimum tax. He then sells the stock for $100 a share and has no other gains or losses. So he has a $20 per share capital gain under AMT, and he has a $70 gain per share under the regular tax. Now, when he gets to AMT, should he have to pay capital gain equal to what he had under the regular tax? No, but he's going to have to make an adjustment on his 6251 to reflect that. So if Billy is required to pay AMT in that year, he's going to have to do adjustments on his 6251. But let's look at how these dual bases affect his capital gain under each system. His purchase price under the regular tax is $15,000 because that's 30 shares times the 500 shares, 15,000. Under AMT, he had to realize a gain at the time he purchased. So cost purchase under AMT is $15,000, same as under regular, but at the time he made that purchase, he had to gross up at $50 per share, or $25,000 was added on his 6251 form. So his total cost under the regular tax is $15, but under AMT it's jumped up to $40. Then he turns around and he sells at $100 a share, or $50,000. And so the sales price under both tax rates is the same, $50,000. But how do we figure his profit? Well, the realized profit under the regular tax is going to be $35,000, but under AMT it's only $10,000. So he's going to have a capital gain under alternative minimum tax rules of 10 and a capital gain under the regular tax of 35. Now let's look at what happens if you sell at a loss, which can happen. In our second illustration, we have Sally, who exercised $1,000 of ISOs. And the difference between the exercise price and the fair market value on the date of exercise is $60,000. So the fair market value is 110 per share. On 1,000 shares, she's paying $50 per share. So the exercise price is 50 when the fair market value is 110. The difference between them, the spread, is going to be a difference of $60,000 that she's having to realize under AMT. So during the period that she held the stock, though, its value declined. Exercise price is 50, fair market value is 110. The $60 difference between those is added to income under the AMT, and then the value drops to $90 per share, and that's when she decides to sell. So she sells the stock for a regular tax profit of 40 because $90 per share is more than her cost of 50. She's selling it for a profit under the regular tax. But because she paid 110 under the alternative minimum tax, she's actually selling it at a loss under AMT. So under regular tax, she has a profit. Under alternative minimum tax, she now has a loss. Sadly, the loss limits under AMT rules are the same as they are under regular tax rules, so her loss is only going to be allowed $3,000 a year. So let's see what happens. The difference between Sally's regular tax gain, a gain of $40,000, and her current year allowable AMT gain or loss, a loss of $3,000, is $43,000. She actually has a much larger loss, but she's only going to be allowed to claim $3,000 of it under AMT. Sally will enter $43,000 as an adjustment item on her Form 6251, line 17, and she will also have an alternative minimum capital loss carry forward of $17,000 to be used in future calculations. So this table kind of breaks it up to make more sense of it. Purchase price 50 under the regular tax. Under AMT, it's the same purchase price, but she had to realize a gain under AMT at the time she purchased, making her AMT cost 110 and her cost basis under the regular tax 50. She then sells for 90, and the difference between 90 and 50 under the regular tax is a profit of 40. She sells for 90 under alternative minimum tax, but that generates a loss of 20. The amount of loss she's allowed to realize is only 3. So the difference in between the profit on the regular tax and the profit under the alternative minimum tax is a $43,000 difference, and she has this $17,000 loss carry forward to next year. So that's a fairly complicated equation to have to think your way through. We talk about it a lot more in my class called Understanding the Alternative Minimum Tax, where we actually go through and have you manually figure some rather than just have me explain it. Session 14 password number 3 is Prowler, P-R-O-W-L-E-R. It is now time to complete the Session 14 classwork assignment. And this assignment does not involve preparation of any tax forms. We've got a break from that with this assignment. Your job, though, is to determine the amount of income cost basis and capital gain for each of the following sales. We have classwork assignment number 1, which has to do with a qualifying ISO sale. Seska has been granted 200 shares of Nystrom stock options at $50 a share. She was granted the options on 7/13 of 2009. She then purchased the option on 1/10 of 10 when they're trading for $60 a share and sells the options on 8/23 of 2011 for $65 a share. Your job is to determine what is Seska's basis in her shares, how much will she report as wage income, and how much will she report as capital gain income. Classwork number 2 is a non-qualifying ISO sale, and Kim is granted 100 Voyager Inc. shares on 7/13 of 09 for $40 a share. He exercises the shares on 1/20 of 10 when they are trading for $45 a share, and then he sells them on 4/23 of 11 for $70 a share. So what is Kim's basis in his shares? How much will Kim report as wage income, and how much will Kim report as capital gain income? At this point, I'd like you to push pause on video playback and think through these problems a little bit. Do the best job you can of figuring out the basis, the gain, and the amount of wage income for Seska and Kim. And when you are finished with classwork assignments number 1 and 2, please resume video playback for a review of the classwork answer key. And I now have the Session 14 classwork assignment up on the screen in front of you. And the tricky part about this assignment is just sorting through those rules. Do we have 2 years from the grant date? Do we have 2 years from the grant date? And do we have more than a year from the purchase date? If we meet those thresholds, then we're going to have a gain that is all taxed as capital gain and none of it is taxed as wage income. And in the case of the qualifying options for Seska, we have exactly that. We have an option that was granted on 7/13 of 2009. She purchases on 1/10 of 2010, and then she sells on 8/23 of 2011. So 8/23 of 11 is more than a year after the exercise date, and the sales date is also more than 2 years after the grant date. So we simply look to see what she sells for. She sells for $65 a share. She buys at $50 a share. So we basically end up with a cost basis of $10,000. That's $50 per share times 200 shares, or $10,000. Because this is a qualifying ISO sale, she will report $0 as wage income, and her gain will therefore be $3,000. She's selling at $65 a share. That's $65 times 200 shares, or $13,000. $10,000 is subtracted from $13,000, and that gives her a capital gain, a long-term capital gain of $3,000. Moving on to classwork assignment number 2. What is Kim's basis in his shares? Well, let's take a look. He's granted the options on 7/13 of 9 for $40 a share. He exercises at $40 a share at a time they're selling for $45 a share, and then he sells at $70 a share on 4/23 of 11. Well, the problem with his sales date is although it is more than a year after the exercise date, it is less than 2 years after the grant date. So what that means is that the difference between the fair market value on the date he exercises and the amount he pays has to be grossed up on his W-2 as wages. So if the exercise price is $40 a share when they're trading at $45, then he's going to have to report that $5 per share as wage income. How many shares is he buying? He's buying 100 shares. So 100 times $5 is $500. That means his wage income for that year will be increased by $500, and that gives him a basis per share of $45 rather than $40. So the next question in line is how much will he report as wage income? And I've just told you that. It's $500. And the final stage is to figure out what his capital gain is. Well, he purchases 100 shares at $45 a share, and that gives him a cost of $4,500. He sells for $70 a share, or $7,000, and that gives him a $2,500 gain. So that concludes the review of the Session 14 Classwork 2 answer key. Let's take a look at the homework assignment for Session 14. It is now time to complete the homework assignment for session 14 of the basic tax course, and it's quite a lengthy homework assignment. We're throwing all kinds of different scenarios at you. The first part is relatively simple though. Homework assignment A, problem 1, we're asking you to identify which of the following assets is a capital asset and which is not a capital asset. In problem number 2, we've thrown some multiple choice questions at you. We're asking you to figure the cost basis and answer the questions as shown in these problems. And then we move on to homework assignment B, and it's divided up into 3 parts, each of which is multiple choice. And in part 1, we're again throwing more information at you, asking you to determine cost basis and figure out gain, if any. We're asking you to figure out cost basis and other situations. In part 2, we're throwing a more complex problem at you. We've got Janice Owens, who owns a duplex. She's using some of it for business, some of it for personal, and your job is to figure out her cost basis in each half. That is the business half and her personal half. What is her cost basis in each half? And finally, in part 3, we're actually giving you a settlement statement for Jack Russell, who has purchased a fixer-up house. And you're going to have to tell us what Jack Russell's basis in his fixer flipper is. So that concludes session 14 of the basic tax course. Please complete the homework assignment for session 14. I will see you next time at the beginning of session 15, and we will begin session 15 with a review of the session 13 quiz answer key. Thank you and have fun with your assignments. Bye-bye.